India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Markets getting a little more nervous, a little more edgy. Market made a new high yesterday, but ended in the red. That's the story, the way we pick up things. And of course, I mean, it's largely a Q-less market. Not clueless, but Q-less because US markets were shut. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, Prashant. Good morning. Nigel, morning. I mean, I like what I see, right? Life highs for 3 straight days. Of course, the Nifty cooled off a little bit from fresh highs, but so much buying coming in from domestic institutions. So the setup is good. Let's see where we go from here.
Well, in the last 90 minutes yesterday was a perfect example of how we could see volatility pan out for the next few sessions as well. We fell down. We were down close to around 50 points. We recovered as well. So big volatility, particularly in the last 90 minutes or so.
Absolutely. And I think, initially, right, in the first 2 phases of elections, market got very nervous that turnout is low. There was that sell-off.
Yeah.
Then, all these interviews and sound bites started coming in that, 350 par, 400 par
And
is
the
still
RBI
alive.
dividend.
And the market rallied. And I think as we get into the week, actually finding out what the result is, there is, of course, naturally, I think, a little bit of sort of nervousness, a little bit of edginess. It's normal in that sense till we find out, right? Because no one knows till you open the ballot box, so to speak. Let's just quickly take a look at what you need to know as we begin another session. So Nifty made a new high. And that is yesterday, the Nifty that is. And then, of course, it was a sharp sell-off. The high was made just before 12 noon. The selling accelerated at about 240, 245. And, of course, I mean, the market never really recovered after that. Not very large. It's just that from the day's high, of course, it was a bit of a disappointing close. 22,932 is where we finally left off. Actually, pretty close to support. So 20 hourly, etc. I'll get to that in a bit. Now, FIIs and what they've done is interesting. So in index futures, so we've been talking about this, from 2 lakh net shorts to net short contracts or 98,000 net short to 18,000 net short. And now, as of yesterday, that number is long. So FIIs are from being sort of at an extreme, three sessions back, from 2 lakh net short, they're now 22,000 contracts long as far as index futures are concerned. Now, that is quite a swing, quite a turn that we're talking about. And, we mentioned this on Thursday morning as well, that when from lows, you start a swing, it sometimes ends up on the other end. Not just small net long, but sometimes it can go to a bit of an extreme on the other side as well. We're not there yet, but this is, of course, now a net long market in that sense from an index future perspective. On cash, the selling intensity has been reducing, but there's still sellers. 540 odd crores was sold in the cash market yesterday, but the selling intensity has come down. I think that's a point to be noted. As I said, little by way of fresh cues, US markets were shut overnight. Look at US futures, S&P, the E-mini contract, etc. I mean, not very much happening in Asia, the last I checked. Oil prices are slightly higher, but not by a whole lot. Overnight, you had some comments coming in from G7 leaders, and this kind of talks to the trade tensions between the Western countries and China. And G7 leaders expressed concerns about China's use of non-market trade policies and said that they will take measures to ensure a level playing field. This follows directly from Biden, US President Biden's sort of, tariffs which were put on EV exports out of China, green exports out of China. EV, of course, is one of those things. So, as we go into sort of later this year, and the big one is US elections, I think in that sense, the trade war, which we saw, around the time that Trump came to power for the first time, I think that the noise, the action, etc., will only increase. So, need to watch out for that. Now, 2 speeches from Fed officials later tonight, and senior members will be speaking, and I think markets will watch for clues about what they think of when the appropriate time is to start easing, etc., or if they don't think that now is the time. Just to circle all of this back to levels, so as I said, we are pretty close to support levels. The 20 hourly, as of yesterday's close, we kind of left off at 22,932. The support is 22,915. So intraday, of course, yesterday towards the end, we swung below that level. We got to about 22,800 something, but then there was a bit of a rebound. The bigger sort of support is 22,771, which is the 40 hourly exponential moving average. And this can be used as a bit of a trailing reversal stop as well. break above the high, which is 23,110, of course, will indicate further up move. And Nifty Bank, it continues its outperformance. Yesterday, it sold off also from the day's high, but ended 0.6% higher still. So did far better than the Nifty. And of course, here we're waiting for that 50K number. The all-time high is just under it, 49,974. On the way down, supports again come in at the 20 hourly, which is 48,963, and then at 48,638. So these are kind of very, very near-term support levels. But I think we're in a bit of a holding pattern till we know. And we will know for the first time on Saturday. And if those kind of exit polls are really very varied, some showing one extreme and the other showing some extreme, I think Monday is going to be a little confusing. And then, of course, Tuesday is the actual election result. So expect volatility, expect a bit of indecision as we go into all of that. Sonia.
Oh, absolutely. And volatility can't be ruled out, right? At least until the election results. Yeah. So until counting day, if you are a trader, then it is prudent to be a bit cautious, a bit careful of all the volatility that you're seeing on your screen. But for an investor, for a long-term investor, this is really a good-looking market. I mean, we've been hitting life highs for 3 straight days now. And the buying from domestic institutions is something that continues. That's been coming in thick and fast. In the month of May so far, we have seen buying of almost 42,000 crores. And yesterday as well, over 900 crores of buying has come in. So that money has been relentless. The Nifty is holding at this 22,900 mark, despite all the volatility we saw yesterday. And if you just take a bird's eye view of what's been happening in the market, from the lows that we hit on the 9th of May, the Nifty has gained almost 1,000 points. So it's been a relentless rally ever since, a lot of positive comments came in from the government as well as the RBI dividend, etc. The market has just been moving in one way, and that's upwards. Now, the Nifty Bank is the one that I've been talking about last couple of days. There are some brokerage views that are positive on the Nifty Bank as well. So keep an eye out on that. The 50,000 milestone is not too far away. So that's the next level to watch on the Bank Nifty. Now, as Prashant was also mentioning, FIIs have now almost covered all shorts and are now net long in this market. So if you look at what's happening in terms of index futures, right, FIIs net bought 5,400 crores in index futures yesterday. In terms of individual stocks, a lot of the PSUs have been coming out with numbers. So just a quick word on that. It has been a mixed bag in terms of PSU earnings. NMDC was on the weaker side, but you had Nalco and LIC that were decent set of numbers. We'll talk about that in greater detail. But for now, the GIFT Nifty is suggesting a strong start, a 40-point higher move. So it looks like that positive trend that we've seen the last couple of days could continue, but with some volatility.
Well, that's right. And the FI as well, they are net long for the first time since the 2nd of May. Remember, they were aggressively net short, and now they've covered all of that. So the first time since the 2nd of May that the FIs are net long on the index. Today, we'll also keep an eye out on the financial Nifty because that plays out weekly expiry. So some bit of volatility on that front as well. What did the FIs do yesterday? Well, they covered more than 30,000 short contracts. They added some mild long positions, and that's what takes the long positioning now to around 52%. Just a few sessions ago, it was less than 30%. That's moved to around 52%. In fact, let's just pull up a chart of what's transpired in the last 1 week or the last 5 sessions or so. The long additions is nearly around 1.5 lakh contracts, and the shorts have got covered up more than 1 lakh contracts. So the swing factor out there is nearly around, more than 2.5 lakh contracts. And the chart actually will tell you, and if you pull up a graph up for you on the screen, it'll tell you, they were mildly net long earlier in this month. Then they went aggressively net short with close to around 2.5 lakh contracts on the short side. And now we are back to the net long positions of around 22,000 net long contracts. The short point is bulk of that short covering has taken place, which explains why from 22,000 we have moved to around 23,000 odd. What about the options data? Well, the call writers believe they want to defend these higher levels, and that's where you're seeing the 23,200 call, 23,100 call. Well, it saw a fair bit of addition in yesterday's trading session, big build up, close to around 30 lakh shares getting added between both of them, which brings us to the levels. Since these levels are getting aggressively written, or these strikes are getting written aggressively, that's why there is some resistance at around this 23,150 to around 23,200 odd mark. The support, that's the previous resistance. It comes in at around 22,700. While if that breaks, then the 20 DMA is what you're looking at. The Nifty Financial Services Index, well, that will play out the weekly expiry as well. And there was a fair bit of options data that was active yesterday as well, though it came off the high point of the day. So that's the index to watch for the last 60 minutes. Stocks that I'm looking out for, I'm looking at the PSU miners for today's session. Nalco, well, the stock will open up well in the green. It's come out of the F&O ban. So that one will react positively to a set of numbers. NMDC, the numbers are quite disappointing. So I'll be interested to see what happens. The stock should open up lower, and then it'll be interesting to see what happens out there. And GMDC, on a sequential basis, there's a bit of a recovery. The stock has corrected a fair bit from the top. So the PSU miners is something that I'll be keeping a track on.
Okay, so plenty of stocks to talk about this morning, but let's also tell you what's happening in the money markets, right? Some views coming in. Abhishek Goenka of India FX and Asset Management says the US one-year inflation expectation is coming in lower than expected, and that has caused the dollar to weaken a bit. He says the key data this week would be the April PCE print due for release on Friday. He says the rupee has come off the lows and is the strongest in about 2 months. He adds revival in FPI sentiment posts a much bigger than expected surplus transfer by the RBI to the government, and that has aided the rupee. He expects the rupee to trade in a range of 82.60 to 83.60 over the medium term with a slight appreciation bias.
Okay, well, on bonds, we have Vishal Goenka of IndiaBonds.com, who says bond markets rallied last week on RBI cash transfer to the government. He expects markets to remain range-bound ahead of election results next week. He says RBI is likely to remain on hold next week at their policy meeting. It goes on to add the global cues for interest rates still remain mixed in a way direction. He expects a 10-year benchmark bond yield to be between 7.01 to 7.06%.
Well, a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. We're looking at LIC, United Spirits, Nalco, GMDC, TVS Supply Chain. All of them will be reacting to positive news flow. On the flip side, 5 apiece. So we have 5 stocks reacting to negative news flow. That's NMDC, Natco, Borosil Renewables, Simply in India, and Concord Biotech.
Dean Kim is with us, Head of Global Research Product at William O'Neill & Company. Dean, good to have you with us here. Good morning. Thanks very much for your time. Just a quick word, Dean, on how sort of indices are looking on technicals, price action. The Nifty, of course, dithering. We are pretty much at all-time highs. Nifty Bank is close at about 50,000. How are you looking at, the near term for Indian indices?
Yeah, India indices are approaching all-time high. I think the action has been fairly constructive. I look at volumes a lot, and the volume has been sort of muted or below average. But I think you're going to get a signal one way or the other when you see a day with high volume. So I think if you get a high volume on an up day, that's a clear sign that the market wants to have a sustained uptrend. On the other hand, if you see a higher volume and a down day, we would, keep an eye on the market and basically become slightly more cautious. But so far, I think India, as well as other emerging markets, they're doing quite well these days.
Okay, they're doing quite well. Dean, hi, good morning. So just wanted to focus a little more on the Bank Nifty because we're almost at the 50,000 milestone. Do you think it's an uninterrupted uptrend from here on the charts? And if yes, which are the banks that could support the market in the next leg of this rally?
Yeah, from technical perspective, certainly the state-owned banks, they look fairly good. I think Federal Bank, State Bank of India, Bank of Maharashtra, basically, they're actionable now. We're keeping an eye on the private banks. ICICI is the best one amongst the group. HDFC, just retook the 200-day moving average, so that is setting up. We just, need some volume to come in. It's on the right side of the base. And so, as you see emerging markets doing better, I think globally, I'm noticing that banks are doing quite well. Even in Europe, we're noticing, banks are certainly accelerating there, and pockets of emerging markets. So I would stay patient with private sector banks for now. Let's see what happens after the election, because the yield curve continues to be flat. And I think that's what foreign investors, they kind of key off on the yield curve. But hopefully that will change to become steeper post-elections.
Hi, Dean. Good morning and good to see you. Well, you also track the broader market here in India, apart from these large cap names. I recall you talking about Thermax, Finolex Industries. Both of them did very, very well in the last 60 days or so. What's new on your list from the mid-cap space?
Yeah, I mean, looking at, cap equipment continues to do well, like KSB, LTD, cementation, Wellspun is another one. I think they're setting up early stage bases. On the consumer side, you have Indian Railway Catering, also Bosch, UNO Minda. Godrej, popped up in my screen as a stock that looks attractive. Then you have the smaller financial names like Muhut Finance, Central Depository of India, and then pockets of healthcare like Orindo Pharma. I think that's setting up on an early stage base. So still a lot of good names. Certainly the small caps, they've been doing very well, but we tend to focus more on the mid cap and large cap.
What is the downside for this market now? We have a big event upon us. If that event does not go in favor of the markets, then where do you see the floor of this market in the near term?
Yeah, we're looking at the rising 10-day moving average as the next level of support, followed by the 21-day moving average. And like I said, I think we should pay attention to the volume, because if we get volume one way or the other, that would be a telling sign where the market wants to go. So I would watch those levels. I think 21-day should provide strong support. But if we were to break that, then obviously the next level of support would be 50-day moving average.
Okay, so 21-day and then 50-day moving average. Got it. Dean, thanks a lot for joining and appreciate your time here on CNBC-TV18. So that's the word coming in on the technicals of the market and how you should approach it. They still prefer banks. Within that, the PSU banks are their preferred lot, and then private sector. Let's slip into a quick break. On the other side of the break, our list of top 10 stocks is lined up with our entire research team. Stay with us. Welcome back to Bazaar Morning Call. This morning, the Gift Nifty is suggesting a strong start. Now, with the markets almost at trading around lifetime highs and FIIs have now turned net long in this market, is this uptrend going to continue? The Nifty implied opening suggests so, but let's see, there's been a lot of volatility as well. Our research team is standing by with the list of top 10 stocks that you need to watch out for today. First up, Nigel will tell us about NMDC and how the numbers look. Nigel.
Well, that's right. NMDC's numbers on the top line actually was in line with what we're working with. We already had the volume numbers, so the other parameter was in line, given that the top line is in line. The disappointment has come in on the EBITDA, because most brokerages were either at around 2,500 crores or in excess of that, and the number that's been delivered is around 2,100 crores. So that's around a 16% miss in comparison to the poll number, which explains why the margins as well were lower. Two factors did hurt them. One was the royalty. On a per ton basis, on a sequential basis, it's gone up by close to around 20%. As a percentage of sales, it's at around 47%. That's much higher than the 42 to 45%. And other expenditure as well is higher. Maybe some part of the other expenditure could be one-off, given that it's the final, it's the final quarter of the year. So the numbers are disappointing. Expect the stock to open up in the red, but let's see what happens from there, because in April itself, they're taking another price increase. That's about NMDC, but let's go to Mangalam to tell us about United Spirits. Mangalam, morning.
Good morning. So yesterday, United Spirits had their conference call at 3:30, so that was post-markets. Important takeaways that we got from there. One, there has been pressure for the consumers at the lower end of the wallet, and as a result of which, there could be moderation expected for a couple of more quarters, and that's largely because of their popular volumes. For premium trends, they continue to be intact. In fact, the company continues to target double-digit volume growth in prestige and above on a full year basis, and also they target double-digit revenue growth for the full year, most likely to be back-ended in the second half of this year itself, and that's something which is a positive. The other positive is that they see no impact of demand on account of elections, and while commodity inflation has seen some moderation, they will see some margin expansion. Remember, last year on a year-on-year basis, they've beat street expectations and their own guidance on margins by about 100 basis points. So maybe the expansion may not be as much as what they saw in the last 1 year. Brokerages are largely positive, but a little conservative given the valuations as well. So Macquarie has raised their EPS estimates by about 6 to 7%. ISEC continues to maintain their ad rating with a target price of 1,200. And JP Morgan says that they underperform at current valuations, largely because they believe medium-term upside is priced in. So on account of all of this, I expect mild green on United Spirits today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's get back to the PSU miners. I'm looking at Nalco first up. Those numbers look good. On the top line, there was a bit of a miss out there, in all probability because of lower alumina sales. But the EBITDA number was beautiful. It beat estimates by close to around 15%. NMDC missed estimates by around 15-16%. Nalco has gone ahead and beat estimates by close to around 15%, coming in around 1,100 crores odd. Two factors played out. One is other expenditure is much lower, and they're getting the benefit of using captive coal, which explains why the cost of power and fuel has come down drastically by close to around 16%, despite producing a little bit more aluminium. So that's positive. The segmental breakup as well comes up for you on the screen. You have the chemicals business, which is effectively the aluminum business. That's the one that drove this beat. Came in at around 500 crores approximately, while the aluminium business was steady. And keep in mind, aluminium prices have moved up. So in Q1, these numbers will look even better. So going with green on that one, there's a technical parameter as well that has come out of the F&O band. So green on Nalco. Next, moving to GMDC. Year-on-year, weak set of numbers is what they delivered. However, on a sequential basis, there is a recovery. So on a sequential basis, the revenues are up by close to around 30%. Even on the EBITDA front, just take a look at the recovery we have seen on a sequential basis. From 21%, it's gone to around 27%. So I think because of the sequential recovery we have seen in the operating profit, the street will like it. They've also gone ahead and given a dividend of around 9 rupees 55 paise. The stock has corrected 20% from the recent peak. There's a sequential recovery and the dividend bodes well. So I'm expecting green on this particular counter.
Okay, well, let's go across to Ekta. She's joining in to talk about Natco Pharma and why you should be watching that one. Ekta, good morning.
Morning. There was the highest ever revenue and profit for FY24, which was delivered by Natco Pharma, and that is because of Revlimid generic and the contribution that they've seen from that particular drug. There was, for Q4, there was a one-time charge of around 90 crores in the domestic business, which one needs to account for. Numbers again were higher due to Revlimid generic contribution, but were below Nuvama estimates. So revenue came in at 1,068 crores versus estimates of 1,109 crores. EBITDA 497.3 crores versus estimates of over 500 crores. Margins 46.6% versus 37.8%. And profit 386 crores. Street was anticipating over 400 odd crores. So based on what they have reported versus estimates, it's below. But if you look at it on a year-on-year basis, it's a handsome set of numbers only because of the contribution of the US business and especially from Revlimid generic.
Okay, and yesterday was a busy day with pharma, lots of pharma yesterday, and we'll come back, Ekta, with more with you as the day goes along. Thanks for that. That's Natco in focus. Now let's focus on LIC, the largest insurer in the country, and what are the numbers looking like? Vamakshi's got details here. Vamakshi, morning.
Well, good morning, Prashant. Well, absolutely a good set of numbers coming in from LIC. When we look at the total annualized premium equivalent, or APE, that is seeing a growth of almost 11% on a YOY basis, and the estimates were somewhere around 4% growth. So definitely this is a beat coming as far as total APE is concerned. Now, out of that, the group APE has managed to grow by almost 61%, but this is much lower as compared to what we were expecting. It is we were expecting somewhere a growth of somewhere around 109%. The individual APE, however, was down only 2% versus estimates of a fall of almost 23%. So this is better than what we were expecting. So overall, as a result, we're seeing a beat as far as total APE is concerned. The value of the new business, however, is seeing a downtick of almost 2% at 3,645 crores, and the value of new business margin is also down nearly 215 basis points at 17.21%. But overall, as far as APE is concerned, it's a beat, and as a result, I'm going with the green for LIC.
Okay, thanks a lot for that, Vamakshi. Well, let's hop across to Vivek and wind down this segment. He's joining us to tell us about Borosil Renewables, TVS supply chain as well. Morning, Vivek.
Well, good morning. As far as Borosil Renewables are concerned, along the lines of what the management has been guiding, it's been a double whammy. In the negative sense, as far as Borosil Renewables is concerned, Q4 has been an operationally weak quarter. Let's have a look at the numbers first. Revenue is down almost 8% on a year-on-year basis. An operational loss this time around of 25.5 crore versus an operational profit last time around. And on the bottom line, the company has gone ahead and reported a loss of 53 crore versus a profitability last time around. So what exactly has impacted the company's performance this time around? As far as the export subsidiaries are concerned, what's actually happened is that weak demand in Europe has gone ahead and impacted the performance over there. Now coming to the Indian market, along the lines of what the company has been saying, due to the overpresence or dumping as far as Chinese players are concerned, the selling price in India has been impacted significantly, and that has gone ahead and impacted the EBITDA. Along with that, when you're talking about the prices of solar grade silicon, it has dropped by almost 80% on a year-on-year basis, now at 10.3 cents per watt as far as May 15th, the recent rates were concerned. So as far as Borosil Renewables is concerned, the key to watch out for would be the imposition of ALMM. Now coming to TVS supply chain, a reasonably good operational performance by the company. Revenues higher by almost 4.5%. Now when you're talking about the integrated supply chain segment, that continues to grow. EBITDA higher by 3.7% on a year-on-year basis. Margins largely flat, 7.1% versus 7.2%. Profitability of 5.38 crores this time around versus a loss of a little over 12 crore last time around. What is it that the company has guided for? The company says they expect to reach 4% PBT margins by FY27 versus just 0.3% now, and the ROCE target is at 16.5% by FY27 versus around 4.8 now.
Okay, what about Timken? You're also tracking that one, Vivek?
Well, in Timken, we are expecting a very large block deal today. We are going with the red with this particular name. This is simply due to the large discount that this particular deal is going to happen at. So we understand that the promoter entity, which is Timken Singapore, that currently holds a little over 57% stake in the company, is looking to go ahead and pair 6.6% stake. Now, this particular deal should happen at a floor price of 35.50 rupees a share and a discount of 10.2% to yesterday's closing price. The broker for this particular deal is BofA Securities, and there is a lockup of 180 days for further sale of shares. Now, it is important to note that post this particular deal, the shareholding of Timken Singapore will fall to 51.1%, which indicates that there could be some sort of very less room for maneuvering as far as further sale of shares is concerned, because there could be a loss of a simple majority. So that particular overhang, it will be important to see whether that goes away after today's deal. So maybe opening in the red, you could see some recovery happening in case this particular overhang goes ahead. Now, when you're talking about some context, in June 2023, Timken Singapore sold a little over 10% stake in the company. That time, the floor price was 3,000 rupees a share, which was a 14% discount to the previous day's share. So now there has been a significant reduction as far as Timken Singapore's holding in Timken India is concerned.
All right. Well, there's one more. Vivek, thanks very much for that. There's one more deal. Concord Biotech will see that. Abhishek is here with details on this one. Abhishek.
Well, Prashant, sources tell us that there will be a block in Concord Biotech. Citigroup is the sole book runner over there, and Ontario Incorporation is the seller. So the floor price is at 1,320. As Vivek alluded to, there are steep discounts happening in block deals. So there is a steep discount of 8.5% to yesterday's closing price in this deal as well. The offer size is about 468 crores when calculated at the floor price. So 3.4% of equity is on offer with respect to selling. So seller will have a residual stake of 2% post the transaction. 90 days lock-in is there for the seller. Back to you.
Okay, thanks a lot for that. Plenty of stocks to watch. Here's a quick recap. Stocks with positive news flow: LIC, United Spirits, Nalco, GMDC and TVS Supply Chain. While stocks with negative news flow: NMDC, Natco Pharma, Borosil Renewables, Timken India and Concord Biotech. But let's also get a handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Well, it really has to do with the geopolitical tensions across the globe that the commodity markets are looking at right now, from what's happened with Israel, with Russia saying that they will build a small nuclear power plant in Uzbekistan, with weather concerns and thunderstorms that we've seen in U.S. also leading to some damage. There is safe haven buying that has returned in many of these tangible commodities. So whether it's gold, which gained up by nearly 1.5% overnight, now trading about $23.50 an ounce, or silver prices, which reacted with 4.5% of a surge, back above $31 an ounce right now. It was also the case with the base metal prices. So whether it was copper, which gained 1.5%, aluminum or zinc, which also are trading quite positive. So all of the metals are trading in the positive in Asia yet again. The markets will also watch out for the US PCE data and the China PMI numbers. Well, that will be in focus now for the further direction into the street. We also have seen a bit of a decline in US dollar index, which has been supportive and is the reason that you have crude oil as well back above 83 right now. So all commodities off its lows, and we've seen some opportunity buying come back.
All right, Manisha, thanks very much for that. So, quieter in terms of commodities over as compared to the last 1 week or so. Manisha, we'll come back with more. We'll take a break here. Amnish Agarwal of Prabhudas Lilladher will join in for some specific stock talk when we return. Stay with us.
Welcome back. Hope you're having a good morning. Well, we've listed down all the stocks for you. Let's get some more fundamental analysis going. We have Amnish Agarwal, the head of research at Prabhudas Lilladher, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Well, I wanted your view on the insurance space, and in that backdrop, LIC's numbers, valuation-wise, it has come forward, but they've lost some market share on a year-to-year basis. At these prices, what's your view?
Okay, yeah. You see, we don't have coverage on LIC per se, but having said that, the loss of market share, whether it is for LIC or any other large player, whether it was a Maruti in case of cars, so these are something which are natural when you have open market, more and more people come in. So I will not go by the loss of market share for LIC because the space has seen entry of many new players over the years. As far as the profitability is concerned, I think the profitability has been good given the size of where LIC is. And I think the way your PSU stocks are poised, LIC has the potential to give further returns from here. The only factor to watch out for in case of all PSUs in general and LIC in particular would be the elections. So once I think there is more clarity on the government, one can take a slightly longer call on a stock like LIC.
Okay. Amnish, hi, good morning, and thanks for joining in. I wanted your thoughts on Exide because there's a unanimous, buy call from brokerages on Exide, and the stock has had a dream run this year. But there are plenty of positive triggers as well, especially in the lithium-ion battery segment. Is it still worth buying at this price?
Hi, Sonia. You see, the main thing is both the engines are firing for the company. Now you look at, say, your auto sector. The auto sector is also doing well, which is one of the main drivers as far as your growth is concerned. And second is the lithium-ion battery project. So the only issue seems to be, I think the stock has literally more than doubled or close to that over the past, say, 8 to 12 months. So I think incrementally a lot will depend upon how the lithium-ion, your project starts stabilizing and it starts contributing. Because if you look at valuations and all, I think all the easy money in the stock, I think that has already been made.
You know, I was looking at a few notes, Amnish, on Exide yesterday, and expectation is that they'll do, I saw one with Investec, they have a buy, etc. The most aggressive is Nomura. Investec says they'll do about $18 in earnings in FY25. I mean, we've got more expensive things out there in the market. If you believe, others believe they could do 25 rupees. Then, it changes depending on what you model in, as is always the case. But you think the best is behind in that sense for names like Exide?
No, you see, what I am saying is that the stock has it is close to double, okay, in the past, say, 8 to 9 months. Now, it will all depend upon what kind of earnings we get. For example, if you look at in general the auto industry, this year's growth rate, except the two-wheelers, maybe is a tad lower than what we have seen in the last year. Then it all boils down to how will be the margin expansion happening in your core business, usually primarily led by what happens on the prices of lead. Now, if that plays out well, the stock has the potential to trade anywhere between 25 to 30 times, depending on where the earnings come. But if you look at the current price and then you compare relative to what has happened in the last 6 to 8 months, where the stock has rallied from, I think, 260 to 70, then the returns will be more measured in the, I would say, the coming few months. But in the long term, it will be a function of how your lithium-ion battery project goes.
Okay. All right, Amnish, just stay on. We'll come to you in a bit. Here in the studio, we have Rikin Shah, who's joining in. This is putting the spotlight on the Q4 bank earnings. IIFL Securities in a recent note said that Q4 was a quarter of modest positive earnings revision, adding that banks with elevated credit deposit ratio lost market share in FY24. Rikin is with us. He's a vice president at IIFL Securities. Rikin, hi, good morning, and thank you for joining us in the studio. It's a pleasure to have you here. I wanted to start with HDFC Bank because it has been the biggest underperformer. But now, recently, in the past couple of days, we've seen some delivery-based buying come back in HDFC Bank. Your thoughts on that and the way forward?
Okay, so thanks foremost for having me on your show. So on HDFC Bank, we have a buy rating from medium-term perspective. If we take a step back and look at what was plaguing the stock, a lot of things have been plumbed in the last couple of quarters, whether it's in terms of communication to the broader investor community or focus on profitability vis-a-vis growth. So from here onwards, the way we think about it is that most of the negative surprises for the stocks should be largely behind us. The way we think about HDFC Bank fundamentally is that the loan growth is going to be slower at 12-13% for next few years because they have to bring down their CD ratio and hence they'll be losing incremental loan market share. Having said that, the margin outcomes will be relatively much better than the other banks, even in the short term before the rate cut cycle starts and even after the rate cut cycle starts. The other piece would be on the OPEX. Along with some other large private banks, they have the lever to pull back on the OPEX. And asset quality is going to normalize similar to other banks for them. So net-net, what we are saying for HDFC Bank is that you are largely going to make a stable kind of ROAs with the key lever of the margin, which will be a better relative outcome vis-a-vis other private banks. And given where the valuations are, an investor who is looking at a large banking franchise from a medium-term perspective, which has potential to gain significant loan and deposit market share over an extended period of time, this makes an interesting stock pick.
Okay, all right. Hi, Riken. Good morning and good to see you in the studio. Since you spoke about market share on the deposit front as well, how were the past quarter's numbers, first of all? And if you could tell us who gained and who lost market share?
Sure. So if you look at, Nigel, the deposit growth, the 4Q is seasonally typically strong across the banks. Yeah. And that is what we saw in the 4Q as well. So for the banking system as a whole, the deposits grew by 6 to 7% QOQ, but the YOY growth was still around 13.5%. But the interesting bit within the deposits is that the large private banks are growing much faster than the system. We are looking at system deposit growth of 17-18%, whereas the PSU banks are growing only at 11%. Now, what we are essentially saying here is that if we look at the last year that has gone by, the PSU banks have lost deposit market share anywhere between 30 to 50 basis points. This is on account of two things. First, we had put out a report a few months ago wherein we had said that the private banks are going deeper into semi-urban and rural India, which is the home turf for PSU banks, and they are bleeding market share there. And second, the PSU banks have been losing the government agency business, which comes in their car and the SA sometimes. So that is why they are losing the market share there.
Okay, so as of now, going by what you said, is bulk of the good news in for the PSU banks, and would you prefer the private banks? Because actually the PSU banks have outperformed in the last 12 to 18 months. Do you think that's going to turn around now?
So the way we are saying is that for the next couple of quarters, there are a couple of cyclical tailwinds which should continue for the PSU banks. What are these tailwinds that I'm talking about? Because of their low LDR, their ability to do much better or stronger loan growth versus deposit growth, relatively better margin outcome, and third, much lower credit cost even versus private banks. So this trends should persist for next 2 to 3 quarters, but post that they should start abating, and that is when in 1 or 2 quarters we would be more positive on the private banks.
You track NBFCs as well?
We have a different analyst who looks at it, but we can discuss.
What are your top ideas there from the house?
So the IFL house, the top picks for us among the larger names are Chola, and among the smaller names we like 5-Star and Shriram.
Yesterday we had a foreign investor here who was talking about how on the lower end, it was largely referring to microfinance and the lower end of the lending segment. He says stress perhaps is likely to rise. That's what he's seeing elsewhere as well. Correct. Is that something you guys sort of notice as well? And Absolutely. Are there investment implications because of that? Absolutely.
So if you look at where the pockets where the stress are emanating from, there are 3 largely things, all of them falling within the purview of the unsecured loans. So the first one is your MFI, second is your credit card, and third is unsecured small ticket size personal loans. What we have been noticing and flagging to our investors is that in the last few quarters, the MFI slippages have been steadily moving up for all the players, even for some of the NBFCs which would be considered gold standard. That's either a function of certain natural calamities in certain geographies or certain political movements in certain parts. Now the slippages have started moving up, the credit costs have started moving up, and there is some worry that the MFI borrowers are significantly levered as well. So this is one segment where we are cautious and looking very closely. Of course, within that also we'll have to be more selective which players can do better.
I want to talk about your other top picks in the sector. In the private sector banks, you have HDFC Bank. You also like Axis Bank.
Sure.
Axis had a superb set of numbers, right, in the last quarter. But what are the triggers from here on? And what is the target price, earnings that you're penciling in?
So, Axis Bank along with HDFC and IndusInd are the only few banks where we are expecting low to mid-teens earning growth for the next couple of years on CAGR basis. For the rest of the banking sector space, the earnings growth is going to be pretty subdued given the margin decline due to the rate cut cycle and credit cost normalization upward. The reason why we like Axis Bank is, number one, we believe the stock has the cleanest cost to asset improvement story. So they have around 90 crore rupees of city integration expenses that they incur every month. From September onwards, it becomes zero. So that directly flows down into the bottom line. We have seen some of the larger banks pulling back on the OPEX. Axis has that lever as well. So that's the first point. The second point is that we have done a residual repricing analysis, which suggests that even before the rate cut cycle starts, the margin outcomes are going to be better for him vis-a-vis ICICI or Kotak Bank. Okay. And of course, Axis Bank would also be growing slower, but a combination of these factors suggests that the earnings growth is going to be better and the valuations are still inexpensive at the current levels.
Okay, all right. And we have got those top buy recommendations that are up for our viewers on the screen. And from the PSU lot, you like Bob better than SBI, it seems, because SBI, I think the target price is 840, which is where we are almost at. Sure. So tell us about that. The top pick from the PSU basket is Bob, I believe.
Sure. So it's more of a relative call, Nigel. So what we are saying is that if you look at how the profitability has trended for both these banks, in last couple of years, Bob and SBI are now delivering almost similar ROAs and ROEs, but Bob is still trading at 25-27% discount versus SBI. And even on our forward-looking numbers, the earnings growth, ROA and ROE trajectory is pretty similar for both the banks. Given our view that the PSU cycle tailwind will last probably only for next couple of quarters, this is more of a relative call where we are saying that because it's more inexpensive and cheaper, we prefer Bob over SBI.
Okay. Rikin, one last point. Broadly, and there was an article yesterday as well, I think Tamal put that piece out saying, is this the lowest we'll see in terms of slippages and stuff, right? I mean, this is a long-standing thing that maybe this is the best environment and it's only going to get incrementally worse, maybe not that worse. Does that have any implications at all in terms of how you think about, investors think about sector? Because, I mean, you don't have to buy a bank.
Sure.
As a banking analyst, of course, I mean, you would like something, you don't like something. As an investor, you can avoid the space. Is that something which you hear?
Okay, so I'll answer it in two parts. The first one is that if you look at the gross slippages, yes, they are very low and benign, but the net slippages have started inching up because the recoveries have started abating from the levels. So of course, there is no doubt, I think the slippages will only move up. But what's in the price? All of us are talking about credit cost normalizing. We have built 20 to 30 basis points of higher credit costs. So that's built into the expectation on the returns. And the problem here is that when the banking sector as a whole delivered the best ROAs and margins, the sector did not get re-rated talking about this is just being cyclical and it will normalize downwards. Now when it's normalizing downward, we can't argue of the sector getting derated.
You can't have it both ways. All right, Rikin, great conversation as always. Thanks very much for your time and thanks for coming by. We'll take a quick commercial break here. We are back. We'll get some technical ideas. Kush and Sudarshan will be with us to help us with that. That's coming up in just a bit. Stay with us. Okay, welcome back. You got what? Just a few minutes to go for the pre-open session. 14 minutes to go for the pre-open session. Anuj is here in Delhi. Anuj, morning. How's the temperature? Still as hot as yesterday?
Morning, Prashant. A bit hotter actually, but that's okay, I guess. We got at least good news from the Met that the monsoon is going to be here soon, and so that's going to be some relief.
I heard some 55 degrees, 57 degrees, not in Delhi, but I think Rajasthan. I mean, it's just incredible.
Yeah. In some places, yes. And in Delhi also, it feels like 50, but it's gone to 43, 44, feels like 50. But anyway, luckily we are inside, so, that helps. But for the market, Prashant, it's once again the same story playing out, the retail trumping over FIIs. I mean, look at how the FII shorts have been butchered over the last few days. I think we both have been talking about this possibility. Nifty rally of 1,000 points and FIs have covered 2.5 lakh short positions. And it's the fourth time it's happened in the last 2 years that whenever FIs have gone this kind of short, the Nifty has given you a 1,000-point rally. And that's a big positive for our market. And it's possible that over the next few days, FIs could actually become net long and add more long positions. But my sense is the next 6 days could be extremely volatile, and yesterday was a teaser of that, the last half an hour yesterday. And if you can't take volatility, then perhaps you want to exit and come back after 5th or 6th June, because the market will keep giving you these kind of pullbacks. Coming to levels then on the Nifty, it's facing congestion for 2 days now between 23,000 and 23,150 thereabout. It slipped twice from there, and that's your first resistance, 23,000 to 23,126, and that's where the maximum call writer is also placed. And the bigger resistance is somewhere around 23,400 to 23,500. Support comes in from yesterday's low and option zone, 22,850 to 22,900, and then of course 5 and 10 day exponential moving average 22,670 to 22,800. On the Bank Nifty, which is the stronger index, there's expiry of Fin Nifty and Bank Nifty today, tomorrow. So let's see if that impacts the Bank Nifty. The resistance 49,650 to 49,700, and then 49,900 to 50,000, the all-time high zone. I leave you with quote of the day, and this one is a bit of a bittersweet for me because yesterday evening, obviously I watched the entire match. Rafael Nadal losing in the first set of French Open. When was the last time that happened, right? When was the last time he was an underdog in the first round of a French Open? The GOAT for me and would be for, eternity. And this quote is something which I've kept in my room also. More than anything, believe you can win. And I believe that he'll come back next year, even though it looks uncertain. But that's the quote of the day.
Okay, thanks a lot, Anuj, for that, and thanks for that very inspiring quote as well. Hopefully, things will cool off both in Delhi, across the country. Monsoons will hit soon, and looking forward to see you again in Mumbai. But let's do one thing. Let's now toss it across to our technical experts. Kush Bora and Sudarshan Sukhani are joining in. Gentlemen, morning to both of you. Sudarshan, I wanted your thoughts first because it's becoming a bit tricky now. Of course, we are at all-time highs, but there's some amount of volatility that's kicking in. But you're also seeing FIIs come back now, perhaps coming back in a big way. Your thoughts on how to approach it from here?
Yeah, good morning. See, the Nifty is in an uptrend, and the chances are that this uptrend will persist and remain. So that part is very clear. The markets have not given a single sign that they want to reverse. So trade is to be on the long side of the market. The second question is of timing. Do you buy now? Do you buy after the election results? And the answer is that you have to go long in this week. This week, luckily, is likely to be a process of consolidation. There will be many dips like we saw yesterday. Buy on a dip, and this is not an intraday trade. Buy on a dip and then hold for next week. So my view is that whether it is the Nifty or the Bank Nifty, look for intraday dips, you will get them, and then take a positional trade.
Okay, all right. Gentlemen, morning. Sudarshan, take that point on board. Kush, what about you? How are you looking at things?
Morning, Prashant. Well, fairly similar. I think, as we've discussed for the last about month or so, the only trade in the market is actually to go long. Whether you go long when the momentum is, there, or you go long on the dips. Certainly, the buy on dip strategy has worked. Even yesterday, the markets were, kind enough to give us that dip towards close. Some see it as volatility. I see it as an opportunity. So any kind of dip towards, if further on from here we get even towards the 22,800 mark, will actually be an excellent buying opportunity, because the broad range for the Nifty setting up as 22,700 and 23,300 as the weekly option straddle is suggesting. So anywhere close to support would be a good entry point. Bank Nifty continues to do well. It will continue to find form. It's in a rising upward channel. So I think from a near-term perspective, 49,700, 50,000 are a very realistic targets to look at. So on the whole, if I were a little bullish, I would pick Bank Nifty over Nifty right now. But both of them have a very clear buy on dip setup.
What about individual stocks, Kush? What are we looking at this morning?
Couple of them, Sonia. Indian hotels from the F&O space is doing well. After a brief struggle with the 20-day moving average, it not only crossed that, it also moved above the 50-day moving average yesterday with stellar volume. So from a near-term perspective, 1350, 1375 are the levels to look at, and 1310 is where you should place your stop loss. Also, Amara Raja batteries, that's the other stock that we are looking at. So from Amara Raja, 1250 and 1275 are the levels to look at. 1195 is where you should place your stop loss. I stand corrected on Indian hotels. The levels are a little different actually. That's 595 and 605. And the stop loss comes in at 570. So I stand corrected on the Indian hotel level.
Thanks, Kush, for that. Well, let's hop across to Sudarshan. Sudarshan, what about your picks for the day?
Well, most of them are on the buy side. That's natural. See, one of them is Birlasoft, which was in a bear market. It is possible that Birlasoft is now coming out of that bear market. It's a buy on dips. Buy with a stop under 586. The only intraday short is ICICI Lombard, which has not participated in any rally. It's an intraday short with a stop above 1725. I also have Indian Hotels. Again, the stock has been in a consolidation. It's coming out of that consolidation on the upside. Consider buying with a stop under 546. And finally, Voltas, same pattern, rally, consolidation, imminent breakout, buy with a stop under 1310.
Okay, well, let's do one thing. Let's also talk about the F&O market now. Let's thank Sudarshan and Kush for joining us. Have a great day, guys. We'll come back to you later. Sneha Seth is also with us. She's the analyst at Angel One, who's going to give us some cues on the F&O market. Sneha, hi, good morning. Your thoughts on how to approach this market? We are getting closer to D-Day, but this is an uptrending market. So would you continue to ride on the upside, and what are the stocks to look at?
Yes, very good morning, Sonia. With yesterday's profit taking, we haven't seen any major, change in data. We have seen some long unwinding. However, FIs were, they have covered decent shorts and index futures. And in stock options also, they have been buyers. So the data remains positive, I think. 22,800, 22,700 should be acting as a support. So in case of any declines, one should use these declines to add fresh longs. On the higher side, 23,200, 300 is the levels to watch out. As far as individual counters are concerned, I have a two buy call. The first one is on IRB. This counter looks quite good and has formed decent support around 85, 83 odd levels. So I would recommend buying this counter for the target of 81, sorry. It has made a base around 65 odd levels. So we can go ahead and long this counter with a strict stop loss around 68, and the target can be expected around 81 followed by 85. Apart from this, Dabur is a buy for me. The stop loss can be maintained around 556, and the target expected will be around 588.
Okay, thanks a lot for that. Let's take a quick break on that note. On the other side, we'll come back with the pre-opening rates. Later, we'll connect with Rahul Talele, the Group Chief Executive Officer at Colgate Developers, to discuss their Q4 performance. Stay tuned. Welcome back. We're just, I think, about 3 or 4 minutes and we'll have the pre-opening rates on the screen. Amnish Agarwal is still with us to talk about individual stocks. Amnish, the one space that has been seeing some traction lately in terms of earnings is pharmaceutical, right? The recent numbers that I can remember, which were quite decent, one was, of course, Divi's Labs, where the margins came in above 30% for the first time in 5 quarters. And then you have Orindo Pharma as well, good margins, decent revenue growth. From the entire pharmaceutical space, what would your pick of the pack be?
You see, our top picks have been Sun Pharma and Cipla from quite some time. But having said that, we have recently upgraded Divi's. We were having a negative view on this stock. Now we have given an accumulated rating on the stock, because if you look at the current quarters, the margin expansions have positively surprised, and there are many more products which are in the pipeline for the company. So from here on, the stock is unlikely to see any major correction and can give you returns over a period of time. But overall, I think Cipla and Sun, they remain as our topics in the space.
Okay, got it. Amnish, what about United Spirits, United Breweries? Both those two stocks have done well from their recent lows. United Spirits, going by the numbers and commentary, the second half of this year should be better as well. United Breweries as well did see a good recovery from the lows. How would you view both these two stocks? And from the Alco Bev companies, what do you like the most?
You see, United Spirits, I think this quarter was driven mainly by margins. And now with the balance sheet being in good place, and if they are able to generate, say, mid to high single digit kind of a top line growth, and the way premiumization is happening, I think in the long term, the company will do well. If you look at near term, I think if you your last year numbers and all, the P multiples, you might not find the stock very cheap. But given the fact that now it's a debt-free company, it's on the dividend list, and the premiumization drive is there, in the long term, the stock can give you very steady secular returns. In case of United Breweries, I think the past few quarters have not been that great, but beer as a segment continues to look good in the longer term. I think after the, you can say, consolidation for some time, I think the stock can actually move up. But I don't have any firm view on the numbers of breweries.
Okay, that's fine. In the commercial vehicle space, a stock that stands out is Ashok Leyland. It hit a fresh 52-week high yesterday. It's already up 20% in this year, and the management was very optimistic that FY25 will be a good year. Is a risk-reward favorable for investors now?
You see, Ashok Leyland, for example, if you look at the entire CV space in the past few months, there has been some sort of a slowdown as far as your volumes are concerned. The volumes have not been that great, but what has been surprising is the way the margin expansion has happened. Now, with your steel prices inching up, and if the volumes don't grow even in the second half, then there could be some risk to margins as far as Ashok Leyland is concerned. I think the 20% rise which has already happened in the stock, I think the stock may take some breather. But I think the main factor to watch out here would be the margins, because the guidance of margins remains very strong.
Okay, we'll come back to you in a bit. We also want to focus a little bit on the real estate sector now. Colgate Developers is the first management on the show. It was a decent set of Q4 numbers. The stock, though, is the biggest underperformer from the realty pack. Bookings in Q4 missed estimates and realization came in flat. We have Rahul Talele, the Group Chief Executive Officer at Colgate Developers, who joins in. Rahul, thanks a lot for joining in. You know, now that FY24 is behind us, let's just take stock of what FY25 could bring about, right? In the last fiscal, you saw the highest ever bookings at about 2,800 crores, which was a growth of 26%. Now, that was largely in line with your guidance. Can you tell us, both in terms of bookings, at 2,800 crores is the base, and in terms of, million square feet, about 3.9 million square feet is where you're at. What do you see FY25 like? How much can you build on to that? If you can share some numbers with us.
Sure. Thank you, Sonia, for having on your show once again. So, see, FY25 was again, FY24 was, highest ever on multiple parameters for us in terms of, the pre-sales number, in terms of the collection numbers, in terms of the BD closure, likewise in terms of the lowest net debt to equity ratio. So going forward, since FY25, we are confident of launching around 8,000 crores worth project. So our pre-sales guidance for FY25 is around 3,500 crores, and in FY26, our guidance would be around 4,500 crores. So whatever the pre-sales number that we have achieved in last 3 years, so we are planning to double that pre-sales guidance for the upcoming 3 years, from 6,800 to 13,500 for FY25, 26, and 27.
The one concern is that, some of your new launches, especially in Q4, have been short of what the street was expecting, and there have been some delays as well. I understand that the premium phase at Life Republic was deliberately delayed in order to achieve certain thresholds of sales. Can you tell us a little more about what is the launch pipeline? I mean, you gave us the pre-sales guidance of 3,500 crores for FY25, but what is the launch pipeline that you're looking at? And some of these legacy projects have been seeing higher overheads and higher expenses as well, which has hit your profitability. Is that something that we can expect even in the next few quarters?
Sonia, let me try to answer the second part of question. See, what are the projects that we have launched in second half of FY23 onwards? Over there, if we, for a simplicity of understanding, we internally, we try to calculate the embedded EBITDA numbers at a project level with the overheads of around 10%. So for FY23, since the half year was with legacy project, half year was with the new projects, this EBITDA margins is at 18%. For FY24, this embedded EBITDA margins is already at 26%. So what are the projects that we have launched in last financial year, FY23 H2 onwards? So we are confident of achieving a significant, price betterment as well as margin betterments, and which will get reflected into FY26 last quarter onwards in revenue recognition. And so is the case in terms of the P&L numbers as well. So yes, you are right. A few of the legacy projects which had a lower margin, our average realization around 4 years back was around 5,200, 5,100. Right. It has gone to 7,200. So considering that, so a very last leg of couple of 100 crores would be from a historically low margin projects.
Rahul, Rahul, hi, morning. So 7,200 in, just under 7,200 in FY24 realization. What would this number look like? I mean, what are internal kind of expectations on this one?
So FY24 it is 7,200. For FY25 we are expecting around 8,000 rupees square feet of average price realization. At the same time we are planning to launch around 8,000 crores worth inventory in this financial year, and we are confident of that. And it is segregated across portfolio. If you see at Pune we are launching around 2,800 crores worth inventory, at LR 2,500, and likewise highest ever projects will get launched in a Mumbai SBU as well. So that will help company for a diversification perspective.
And you said FY26 pre-sales would be 4,600 crores, right? 3,500 this year and 4,600 in FY26.
Yes, 4,500 crores.
4,500 crores, got that.
Okay, all right. Hi, Rahul. Good morning. Good to see you in. Give us a geographic breakup as well. Currently you're still skewed towards Pune. I think for next year you're looking at around 70%. But say with a little longer time perspective, how do you see the geographic mix shaping up?
So see, if you see the last year, the BD announcement that we have done, half of that is from Mumbai. So from that perspective, so our focus on Mumbai is, so we are largely focusing on Mumbai from a BD perspective. And whatever the projects that we have concluded will get launched in the, ongoing financial year. Considering that, so Q4 onwards, there will be a diversification can be seen by the to the tune of around 25% from Mumbai and Bangalore. So likewise in Bangalore also we are working on a couple of closures, business development closures. So that will be helping company for diversification of around 30%, and maybe we are aiming to have diversification of around 40% in next 2 years beyond Pune.
So all this development that's taking place, right? Will you have to take any debt on board, or will the net cash suffice? I think you're sitting on cash of about 25 crores. Any plans to take on any debt?
Yes, certainly. See, the fact is we are working on multiple BD closures. So some of the BD closures are of significant size. So wherever required to raise debt, so we'll be, very, we'll be cautious while raising a debt. But since we are sitting with very almost nil debt to equity, and board has given an approval up to raise up to 500 crores. So we are okay to raise debt, but see, priority wise will be dependent on the internal accrual. Since most of the projects are getting launched, we are getting a good sales traction, hence the free cash flows are strong. The second dependency will be on a debt.
Okay, so just tell me, how much debt are you comfortable taking? You said there is an approval for 500 crores of...
Yes.
Okay, so is that the level that you're comfortable in terms of taking on debt?
Yes, so that is the comfortable level. So that is around 0.5, 0.6 debt to equity ratio. But yes, we'll be very judicious while raising the debt.
Okay. Got it. You said your embedded EBITDA in FY24, the embedded margin is at 26%, right? I was going through a report by Motilal Oswal where they said that the profitability, although in FY24 was impacted by the completion of legacy projects, going forward, your EBITDA margin by FY26, you can sustainably be at 20% overall EBITDA margin. Is that a reasonable assumption?
Yes, that's correct. So it is a journey of early teens in this financial year to late teens in next financial year.
Okay, all right, Rahul, we'll leave it at that. Thank you so much for joining us and speaking to us on CNBC-TV18. So that is Colgate Patil with the way forward for the business and the improvement in the numbers as well. Let's do one thing. Let's get the 9-10 calls going. First of all, the market is not bad at all. It's about 50 points higher right now on the Nifty. In pre-opening, that is, we'll wait by for the rates to settle though. Sudarshan is back with us. Sudarshan, what's the 9-10 call?
Well, consider buying Indian hotels with a stop under 546.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's focus on a couple of names then that we have been tracking. Nalco, well, that stock has opened up in pre-open. The stock is higher because of a couple of factors. One is the numbers were quite good. And the second factor, it's come out of the F&O ban. So that explains why Nalco has opened up in the green. Let's get straight to the numbers. On the top line, there was a bit of a miss. Why was that? Likely because of lower alumina sales. So that was a bit of an issue for them. But the EBITDA number It's the best in nearly 2 years, coming at around 1,100 crores, which is much better than around the 930, 940 crores that we were estimating. So the EBITDA beat is something that the street likes. What played out in their favor? Other expenditures down by close to 14% on a year-on-year basis, and the cost of power consumed as well has come down. The cost of power has come down because they're taking a higher amount of coal from captive sources, and that's heartening because they're producing higher amount of aluminium and still the power and fuel costs are lower. On both the segments, they did quite well. The alumina business, though, that's the one that delivered the big beat out there. But going ahead in the coming quarter, the aluminium business will do much better because global aluminium prices have moved up. So Nalco goes down as a beat. On the flip side, you have NMDC. Those numbers go down as a miss, and I think in pre-open, the stock is down close to around 2%. So the revenue number, well, that was in line. We already had the volume number, so that meant realizations were in line. But the EBITDA number missed estimates by close to around 14%, which caused margins to come in sub 33%. That compares with around 38%. What went wrong? Other expenditure was higher. Sometimes towards the end of the fiscal year, they do include a couple of one-offs, so that could be one factor. But royalty as a percentage of sales was at around 47%. That compares with around 42, 45% that we have seen in the past. And also, you know, there were a couple of one-offs, but that's below the operational performance. So NMDC starts off in the red, but Q1 could look better because of the price hikes that they've taken. And the street expects a couple of other price hikes as well going ahead. For the time being, down 2%.
Okay, thanks a lot for that. Well, let's hop across to Vivek. Now he's tracking some of the block deals this morning. Vivek, what do you have?
Well, good morning. Even as we speak, some of the block deals are happening, just in the pre-open session. But the first one that we're tracking today, one that we missed highlighting a little earlier is PB Fintech. So what we understand, we had access to the term sheet. We understand that there could be a large block deal that could happen in PB Fintech. Tencent Cloud Europe is looking to sell close to 1.2% stake in the company at 1183 rupees a share, which is a little over 5% discount to yesterday's closing. The total size of the block is $78.3 million. Remember, Tencent Cloud Europe held close to 6.26% stake in the company at the end of the March quarter. So that could be a slight overhang as far as PB Fintech is concerned. The second stock is Timken India. We understand that this block deal is happening even as we speak. Timken Singapore is looking to sell close to 6.6% stake in the company. Remember, they held almost 57.7% stake at the end of the March quarter. So they're bringing it down to just a little over a simple majority as far as Timken India is concerned. Last time they did it in June 2023 at 3,000 rupees a share. And remember, they had utilized it for capital allocation, including a buyback that they were considering. Now, today's floor price for the block deal is 3,550 rupees a share, almost a little over 10% discount to yesterday's closing price. So it'll be interesting to see whether this can recover in case the overhang goes away. Also keep an eye out on Concord Biotech. That is the third block deal that we are anticipating today. Citigroup is the sole broker over here. Ontario INC is the seller. They're looking to sell almost 3.4% of the total equity, floor price of 1320 rupees a share, a little over 8% discount to yesterday's closing. Total offer size is over 460 rupees a share. So 3 large block deals anticipated today, and it appears as though the block deals are coming back.
Okay, thanks for that. Well, Orindo Pharma will also be interesting. So Ekta very helpfully, told us about how there are bulls and bears on the street. So just wanted to get Aurobindo up for you. The bulls are really BofA Securities and Goldman Sachs. So keep an eye out on that. BofA Securities actually has a target price of 13.50 on the stock. Goldman Sachs has a target price of 13.25. And on the bearish side, you have CLSA that has downgraded the stock to an outperform. They have a target price, there you have it, target price of 13.20 on the stock. Now, the bulls, of course, are talking about how the numbers have been quite good, better than expected quarter with 22% margins. And there is a guidance of 21 to 22% margins, and that is pretty much what will drive the upgrade. So that's the bullish view on the stock. Goldman Sachs, in fact, also talks about how there is a further margin expansion on the cards, and the momentum in the US market is picking up quite a bit. So that is why there will be decent growth in FY25. There's good growth for Eugia and the Revlimid generic, right? That's worked very well for them. That ramp up is also positive. But on the bearish side, CLSA has downgraded, as we just told you. They talk about how there is a potential to delay the launch for Eugia. So that is slightly makes them a bit cautious. And they say that, yes, there is margin expansion, but that could be the peak. It could be peak margins now for the company. So that is a little bit of a cautious view. So there's a bull and there's a bear. on Orindo Pharma.
Absolutely. But, for Aurobindo, the fact remains that they've got some of the largest capacities in the US, right? I mean, and if there's going to be, a shortage at some level in some of the drugs, I mean, Aurobindo, of course, in that sense is best placed. Stock is at about 12.15 in the pre-open, so it's higher, about 1.5% Yesterday, of course, it started up and then finally ended lower. By about 1.5%, actually even a little more. So first trades coming up in just a bit from now, and we'll sort of have that up for you. A few other names, right? Maybe we can just sort of run through these names in the pre-open and see how they are all kind of stacking up. Nalco should come up, the pre-open, and how they're, and of course they're strong numbers which showed up. Stocks up 3%, so that's big volumes as well as they're showing. You've got United Spirits, and Mangalam was telling us about that. I think there will be USL in the pre-open as well. NMDC, perhaps another one which should come up. We should also look at Adani Enterprises. That's a nifty stock and was one of the top losers yesterday. The fundraising, of course, the board meeting for fundraising is scheduled for today. So those are a few of the individual names which we will sort of run through as the market starts to open. But
a few more movers from the broader markets. You have Natco Pharma actually has opened up by close to around 7%. So big gains out there. This is one of the notable winners that we can see coming up on the list. Volumes pretty okay. There's another one, Vishnu Prakash. I think that's up by close to around 7%. The stock was up 10% yesterday as well. And I think the new listing, Crystal Services Integrated, that's another one that's opened up at close to around 3-4% approximately. So couple of these names doing well from the broader markets as well. But let's get straight to the action.
Oh, absolutely. Phenolics Cables, right? I mean, that's going to be another one. 40% in 3 days, basically, from 1,000 to 1,400 rupees, roughly. We'll sort of spot that one as well as the first rates start to come through. You got market open, and the Nifty Sensex rates will be up on your screen. Then we'll get to stocks. Nifty is up at 22,979. So in the green, the Sensex is at about 75,492. At this stage. So these are mildly higher sort of starts. 30 points is what the higher start is for the Nifty, and about 70 points on the Nifty Bank. Mid-cap index is starting about 140 points higher. That's about 0.25%. And I think you've got the small-cap index, which is also starting somewhat in that range higher. Mid and small-cap indices, by the way, were firmly up. 0.75% gain by close yesterday, even as the Nifty did sell off. So keep an eye out on that one. But let's take it to Sonia, who's got the stock list. Sonia.
Well, thanks a lot for that. So as you rightly pointed out, it is the Nifty is holding on to gains, right? But here is where the action really is. The Nifty Bank just short of that 50,000 mark. It's up about 100 odd points. So I'm going to take it straight to one of the largest banks, HDFC Bank, which has been seeing some action over the last couple of days. UBS has a buy. They have a target price of 1,900. That is the brokerage this morning. IIFL Securities, we just spoke to the banking analyst who said that most of the negatives are now behind HDFC Bank, and they have a 1,760 rupee target price on HDFC Bank. So this is one stock that I'm looking at this morning. Nalco, as Nigel was telling us, strong earnings, highest quarterly EBITDA in the last 2 years. Look at that. EBITDA is up 44% and the stock is cheering that, up 5% right now on Nalco, one of the big movers on both price and volume action. Keystone Realtors is the other one I'm looking at, about 1% higher. The company has successfully raised 800 crores via the QIP route, so that's a positive. United Spirits is the other one. Premiumization trend is intact, and the company has spoken about a double-digit revenue growth in FY25. The stock is charging ahead up 2.5% as we speak. Couple of PSU banks in focus. I'm looking at Canara Bank because this morning Motilal Oswal put out a note. They had a buy, but they've reiterated a buy with a target price of 140 on Canara Bank, so there's some upside left. They talk about how asset quality is improving, consistent decline in NPA ratios, and earnings growth will sustain at 15 to 18%. Let's hop across now to NMDC. The earnings actually missed estimates, so you can expect some red over there. The top line was in line, but the EBITDA was a miss by 16%. So NMDC is the one that is taking it a bit on the chin this morning. Adani Enterprises, the board will be meeting to consider fundraising today. This one is always in the news, so up almost about 0.3%. Inox Wind, let's pull that one up. 22% equity has changed hands now on Inox Wind. As was expected, that large trade has taken place and that stock is now down almost 8%. I think 153 is the price at which the 1.2% equity, 1.2% equity is on PB Fintech. So the two large deals that we're looking at this morning. So just keep an eye out out on both. But overall for the market, look at this. Not bad, given that we've had a very strong run. We continue to chug along. Just shy of that 23,000 mark. And the Nifty Bank is the one that's really participating, 100 points in the green at opening. Back to you guys.
All right, thanks a lot for that, Sonia. Well, a couple of stocks. NMDC has recovered a little bit from the low point of the day. The street was factoring in that there'll be a price hike that will be coming about. So that's why it's cut its losses. It was down 2%. Now it's as flat as can be. Nalco, well, the stock is flying away. That's one of the big gainers today. It's up closer on 2.5%. Volumes as well. Actually, it's up 5% as we speak. Coming out of the F&O ban and big beat in terms of the EBITDA number, 15% higher than what we were working with. Let's focus on a few stocks. Then you have Arvind. That stock is one of the top gainers, so Arvind Limited should come up for you. Sumitomo came out with a set of numbers, beautiful numbers out there, so that stock is well up and about in today's trading session. You have Natco. Well, that stock, in fact, is flying away. That one is well up and about in today's trading session. Timken, well, that stock as well is doing pretty well. It's recovered a big recovery from the low point of the day. It's up closer on 4.5%. Welspun Enterprises, that's another name in there that's done well. So that stock, in fact, has bounced up. I think it's moving higher and one of the top volume gainers. On the flip side, let's pull up a few stocks. Adore Welding, I'm not sure what's going on with those numbers, but that stock, in fact, is down closer around 10% as per our record. So that stock gets hit. You had Arvind Fashions, that's down closer around 5%. So that as well is coming up on the losers list. AGI Greenpack, that's another stock that's down by close to around 5%. And Praveg, that's the tourism play. The stock had gone to around 1,200 rupees. It's now at around 820 rupees. The numbers came out, it was a little bit disappointing, and some of these stocks have seen a big run. So Praveg is another stock from the BSE listed stocks that's down close to around 6% as we speak. Prashant, what else?
So it's a 40-watt point higher start on the Nifty, and it's looking pretty steady so far. So 22,973. Nothing big, nothing large, but just a steady, decent open is what you have. The Nifty Bank is up about 0.25%, actually 140 points. So 49,440 on the Nifty Bank. Maybe just a few more names before we take it to Manish Gudwani, who's with us on markets. Hindustan Zinc is starting about 3.5% higher. It's got large volumes for this point in the day. There is Hindalco, which is up 2.33%. So these two names from the commodity side are looking good. Nalco, of course, we've been talking about. Sumitomo, we did. United Spirits. Capacite Infra, that's another one which is up about 3%. It's coming out volume, so maybe that's just taking a mention. RR Kabil is up 5%. RR Kabil is also coming up with decent sized volumes. There is Novama, which is up about 2.33%. SW Solar is up about 2.25% or so. Arvind Limited is up 9%, 381 on Arvind Limited at this point. And then there is Torrent Power, which is starting about 3.5% higher as well. So, just a few more names in the broader market which are coming up right now. BDL, Bharat Dynamics, is down 4%. And Phenolics Cables, of course, very large, 40% pull, run up. And today it's down about 3%. So a little bit of pullback coming through, but large volumes here. Garden Reach is also down. Phoenix Limited, Borosil Renewables is down about 4%. On the other side, Nazara is down another 2%, and AstraZeneca is down about 2% or so as well. So this is the long and short of what is up and what is down for this point in the day. Manish Gudwani is with us, CIO at Bandhan Asset Management Company. Manish, good morning. Good to have you with us here. Thank you very much for your time. So from here out, Manish, what are the themes most likely to play out? Because the market, of course, believes that elections, of course, are going to be a big one, but very comfortable with the idea that there will be political continuity, etc. So you've got to think ahead. What are the big macro themes and sectoral themes which will likely play out where one can still make money? Manish, let's start there.
So from a macro perspective, I think the biggest positive spot is the currency to our mind. Both from the perspective that the dollar is likely to be weak to our mind medium term. And the fact, probably more convincing, is the India side, where we're seeing almost a once-in-a-generation shift from current account deficit to a structural neutral current account. So that way, I think for us, one of the big macro themes is the relative strength of Indian currency versus its history, which to our mind can attract a lot of foreign capital. That's on the macro side. On the micro side, we continue to remain broadly positive on the themes we've liked during the last 1 year, which is namely power capex, auto, and pharma. I think these are the three themes, also real estate. So maybe these four themes are what we broadly overweight in our portfolios. Largely domestic, because one is the domestic economy seems to be having more momentum, higher growth, better macro stability than the global economy. And two is that even from a valuation perspective, some of these themes we think are, given the kind of growth that may happen, given the kind of multi-year cycle they are in, we think the valuations are pretty reasonable.
Sorry, Manish, I was trying to come in there, but I'll come to individually these sectors. But on the rupee, which you said that's a big one, are you expecting the currency to strengthen? Is that what you're saying? Or the rate of annual depreciation will be much lesser as compared to history?
See, that will depend on a lot on RBI's policy. I think if we are trying to match Asian currencies because of manufacturing and being competitive, then it may not really appreciate too much, but our forex reserves may keep going up. But the point is that even if it is, let's say, flattish for 2-3 years, I think that's a big break from the past, because historically we've seen 3 to 4% annualized depreciation of the rupee. So a currency which looks to be depreciating a lot less or maybe even flattish, when you see the yield on Indian bonds or Indian fixed income or various Indian assets, and assume that the currency is going to be flattish or not depreciate more than 1%, then I think in the global context, it is very healthy return, which is why I think that medium to long term, there'll be a lot of foreign capital flowing into India of various kinds, whether it is FDI, FI, debt, NRIs buying property, various kinds of capital will come in.
Okay. Manish, hi, good morning and good to see you in after a while. What is the best way for retail investors to approach this market now up until elections, right? Because the long term is intact, we all know that. But in the very shorter term, given that we're sitting at all-time highs, there's some concern about the outcome of the elections not being as favorable for the market as one would have expected about 6 months ago. Your thoughts, and for the here and the now, what's the best advice?
Look, a lot of times in markets, we face these events which are very difficult to predict. And honestly, I think risk management is the key word out here. So everyone should be very clear what is the objective. So for us, for example, if you're benchmark investors, our risk is how much do we deviate from the benchmark. For retail investors, if they are more absolute return focused with a bigger priority on downside protection, that is a different risk profile. But once you recognize the risk profile, I think such a big event, you're better off not taking too much risk. So I think it's perfectly natural for like a fund manager, if they were to go closer to the index, I think that would be perfectly natural and a decent way to handle this event. Similarly, for retail investors, not to be either too over allocated to equities or under allocated to equities is, I think, a good way to handle these big events.
But in terms of, if one wanted to focus on sectors, right, banks have come back in a big way, or at least that's the expectation. Some delivery buying is picking up in private sector banks. Is that a good way to do it? I mean, allocate a little more to private sector banks now, especially the ones that have underperformed, like an HDFC Bank?
The banks, I think, are a decent risk reward. But I do think that they are not going to be the leaders of the bull run. Because A, they're too big, right? I mean, some of them have market caps of 100 billion, 150 billion, whatever. And typically in a bull run, newer sectors get uncovered. So I think, as I said, I think it's good to have decent allocation to banks. But some of the other themes like industrials, power capex, auto, pharma, I think they look more interesting at this point of time.
All right. Hi, Manish. Good morning. Since you mentioned autos, I recall you were bullish, I think, on two parts of autos, PVs and two-wheelers. They played out well. CVs, I don't think you were that bullish. So tell us, what is your current stance on it? Because that's worked out, the overweight stance on autos. Does it have more runway as well from here?
Yeah, I think some of the passenger vehicle, two-wheelers and four-wheeler stocks have become slightly more fairly valued versus last time. Incrementally, I'm a bit more bullish on CVs because, see, traditionally what we've seen with CVs is that it goes through deep down cycle and a sharp up cycle. But the sustained momentum in the economy today could mean that the last 1 to 2 years of consolidation we've seen in CV volumes, unless we see a bit kind of global recession or big unexpected shock, we might see the CV cycle bottom out at these flattish volumes. And also from a valuation perspective, now when you see what is being built into capital goods stocks or a lot of other cyclicals, I think one needs to think through that if these stocks are building in so much of capex and infra happening, will we actually, if that turns out to be true, then the CV volumes have to do relatively okay, I think. I don't think you can expect a CV down cycle and capital goods stocks delivering 30-40% growth. I think that's a bit of a, usually it doesn't happen that way. So incrementally, I'm probably not going to go massively overweight on CV cycle, but some exposure might be okay, I feel.
All right. We'll leave it there. Manish, great speaking with you. Thank you very much for your time. Appreciate you joining us here on CNBC-TV18. Thank you for joining us. Well, you got the market, which is up 50 points. We're at 22,985. So it's a decent start. Market breadth, maybe it's too early, but maybe not. 1,200 stocks are higher, and you got about 900 stocks which are lower.
I just want to mention two stocks which we had focused on yesterday as well, Ashok Leyland and Exide, right? Both those stocks are up once again and up by good volumes. Ashok Leyland is now at 230. Volumes are picking up quite a bit. And look at the volumes on Exide. I mean, this is a stock that is now up almost 60% this year. So big rally over there.
Okay, all right. Well, let's focus on another stock, Laurus Laboratories, well, to understand about what's the way ahead. We're joined by Dr. Chava, the founder and CEO of the company. Hi, sir. Good morning and good to see you. Well, there's been a rumor on the market for the last, 40 days or thereabouts, and you briefly spoke about it in your con call as well. The alternate API supplier for some new innovator. Could you tell us what is the timeline by which we could hear about this? Because the street believes it could either be Merck or MSD. Tell us more about that, about this opportunity. You briefly said, I think, that it was in initial stages. So timeline, and is it Merck?
We don't want to comment on the confidential projects for our partners. But we can tell you there is a definite shift from the big pharma and also large biotechs to diversify their supply base from one country to multiple locations. And we have seen that shift. And we have expanded capacities. We have expanded our technical capabilities as well. And we believe we have invested in capacity expansion at the right time. And we, as we mentioned in our con call, we are working with six out of the 10 big pharma. And we believe our CDMO will definitely will be a driving force for our growth medium to long term.
Right, Dr. Chava, we'll get to that. But, you also mentioned that you're looking at being the alternate API supplier to an innovator. And it's in initial phases. So just on this, by when could we hear about the outcome of this potential large-size deal that you could be bracing for?
We already supply 4 APIs for NCEs for various big pharmas. And this year is going to be a very remarkable year for us because there are 2 NDAs being filed using our API in the US. So once the NDA, the approval will be less than 12 months, then we will have commercial opportunities for 2 APIs. And there are multiple phase 3 projects under execution. and we believe we'll have a good times in the CDMO in the near future.
Mr. Chava, no, so this is not going to be transformative, right? I mean, this is something you already do. So there's going to be one more customer in that sense. Or without getting into anything, we said this is confidential, so we won't push you. But is this transformative in terms of the size of the opportunity?
Definitely, these are high-priced, large-volume products where NDA is being filed. These are not small. These are not in single-digit million. This is a multi-million-dollar opportunities we will capture once the NDA is filed, and then we start supplying the commercial volumes. And and also we have seen a lot of customer visits also happening. That is also an indication that big pharma and large biotechs are looking at diversifying their supply base.
Right. But, so multi-million-dollar opportunity per year. So this is not small. I mean, that's how much you would tell us at this point. So maybe we'll have something definitive sooner. Now, the other thing is this news about the US FDA issuing an untitled letter. This is on the 16th of May for your manufacturing facility in Andhra Pradesh. So summarizing deviations from the GMP practices. The inspection happened in December, 4th through the 12th of December. Could you tell us the status of this? And with regards to the US FDA compliance, I mean, is this plant affected? What is the percentage of sales from this plant as a percentage of your US revenues?
We acquired a unit in 2020, which is called Laurus Labs. When we acquired this site, already has an import alert. So we took that facility and did remediation measures and used that for in-house intermediates. Based on the in-house intermediate usage, FDA inspected in December 2023. We responded to that, and FDA sent another correspondence in 16th of this month. Untitled letter as per FDA forum, a regulatory document, is a correspondence to the industry where the GMP deviation doesn't meet the threshold of a warning letter. This is a correspondence with us, gives us an opportunity to address the two more issues. So we had a 5.483 when FDA inspected. In the untitled letter, they only raised concern on the 2 points. So we'll address that. And this unit contributes less than 1% of our revenue. And also, this unit is not used for any of third-party regulatory sales. There are no DMFs filed from this unit so far. So this is, we believe this is, we are trying to resolve the issues of the import alert on that unit. And we don't see any impact on the corporate level.
Okay, fair enough. Mr. Chava, good morning. This is Sonia here. So you're saying this unit is about 1% of your overall business, so there's not really too much of an impact. So let's move on. I want to ask you about the CDMO business, because there are some concerns about delays in a couple of your critical CDMO projects, and your business was up only 4%. You saw growth of just 4% in the quarter gone by. Can you tell me what is the outlook? By when do you think you can get back to double-digit growth? And these, concerns about the delays in some of your projects, would you want to alleviate any of those concerns?
See, there is no delays in the projects. If you look at the drug discovery from phase 2 to phase 3 to NDA and all, it takes its own time. And that's the reason people who are in the CDMO business, they're fully aware. A CDMO business is very lumpy. So you can't measure the CDMO business quarter on quarter. But we know how many projects we're handling and what are the customers' interest in us, what kind of technology upgradations we have done. So we are very bullish on this segment.
Okay, so you're saying that the business is lumpy, right? So even if you look at it annually, I mean, you were sitting on about 2,100 crores in the CDMO business. That's come down to about 920 crores in this year, in FY24. So that is a significant fall. Going forward, what kind of growth can you look at in FY25? On an average, what are you looking at?
It's going to be significant growth in this year.
Okay, so when you say significant growth, what could it be? 15%, 20%? Let's look at it quarterly, right? I mean, quarterly you're doing about 200, 240 crores in the CDMO space. Can you take that up to 400, 450? Any indications?
We want to comment the CDMO business on the yearly basis. This last year, as you mentioned, we have made more than 900 crores. This year will be, we see significant growth. I will leave it at that stage. Significant, you could guess. It is not teens. It is much higher than that.
Oh, okay. All right. So we'll take significant for that. But Dr. Chava, give us two numbers. And this is for the company on the whole, not talking about the segment. But so let's focus on that. Margins, in the last year, what was encouraging is that the margins steadily recovered all through the year. And the Q4 margins were much better than the Q1 margins. So that was good. So on the margins, when do you get to 20% margins? If you could give us a rough number that we should work with for FY25, that's point number one on margins. And debt is a little bit in excess of that 2,000 crores, but you're doing some capex as well. So you'll get the benefits in the coming years. What is the guidance on both these two? Margins as well as on debt. You could give us a range, sir, if you don't want to give us an exact number, but give us numbers.
We believe we will do, as we also mentioned in the con call, we hope to do 20% plus EBITDA margins this year. What we measure in our business is the gross margins. Are we doing better in our gross margin? Answer is yes, we're able to maintain around 50% gross margin for business. As we are not clocking revenue, our EBITDA margins coming under pressure. As we increase our revenues, things will be fall in place, and we believe this is the year where we will start improving our EBITDA margins. That is on the EBITDA margins.
On the debt, sir, you're going to give us debt. So margins for the year on average, it will be 20% as the gross margins are holding firm. So that's good. What about on the debt number from around this 2,300, 2,400 crores?
I think we will not increase the debt. I think,
not.
As we mentioned, we will not going to cross 2,500. And because we have done major capex already in the last 3 years, this year we do about 700-800 crore capex. That will come from internal. We don't need to raise any further debt this year.
So will it come down, but from this 2,500?
Will come down. Yeah.
In this year, by how much? In FY26, by how much?
We don't want to comment how much, but definitely it will come down.
So, and on top line, sir, what numbers should we sort of expect for FY25? What kind of growth from 5,000 odd crores?
We'll grow. That's what we stop giving the exact guidances. But this year will be definitely we'll see growth in all segments: generic APIs, formulations, oncology, CDMO. This year will be good for us.
Between 12 and 15% growth possible?
I'll not comment on that.
Because we have some numbers here, and the base range where expectations are between 57 and 5,800 crores. Would that be in the ballpark?
Yeah, we don't want to comment, but as you mentioned, we'll have a significant growth this year, and all divisions are doing good.
This ARV business, the antiretroviral business, did quite well. The ARV formulations was up almost 25% year on year. Can you tell us in FY25 what kind of a sustainable growth do you see in ARV?
ARVs, we don't expect significant growth. We believe that will stagnate the current levels, but remaining segments are growing very good.
Okay, so why do you say you will stagnate? I mean, it's been a strong year for you, right, the last year. So what is the reason for ARV seeing stagnation in growth?
The number of new HIV patients being getting into the treatment is limited now. Okay. And there are less new infections. So the number of people on the treatment is not growing much. So the growth is also limited because of that.
Okay, just one quick word on ImmunoAct. You have a 34% stake there. What is the plan going forward? Do you plan to raise your stake further? And, what is the contribution that you see from ImmunoAct?
As of now, we don't have any plans to raise. They don't need money. They are well funded. We did 2 tranches, and they started commercial supplies, and they're doing good. They don't need more money.
Okay, Dr. Chava, you've given us a fair bit of detail and some color as well on the business. Final question before we let you go. A couple of years ago, to 2023, the guidance was around $1 billion, I think, in terms of revenues. And then things, they changed and you couldn't get there. If you have to hit that $1 billion of revenue, which year will it be? Will it be a story of FY27? Street has been waiting for the last couple of years, actually, and got very excited. But then that guidance started getting, pulled back, and the goalposts moved as well. So by when? 27, 26?
I think now for us, we have to demonstrate by numbers, not by saying any targets now.
But you must
So
be
all the
having an
plants have
aspiration, sir.
targets. Yeah,
You must be having an aspiration.
We have aspirations, but our aspirations are big. But we will show those in delivering numbers.
That's
Better way to do it.
That's a better way to do it. Mr. Chava, we appreciate it. Thank you very much. But I think you gave us a sense, and you're sounding confident without putting exact numbers there, which you have done in the past, and for whatever reason. So yeah, I mean, do it and then say it. 20% margins though, 20% plus margins compared to the 15.5 that you did in FY24. That's looking very healthy. So we look forward to speaking with you again, sir. Thank you very much for that conversation, and good luck. We'll take a quick commercial break here. We are going to be back with the management of EID Parry, and we discuss their fourth quarter earnings and outlook for FY25. After that, we'll also have the management of PI Industries, where we talk earnings. Stay with us.
Welcome back. Well, let's focus on EID Parry. We have with us Mr. Muthiah Murugappan, the whole-time director and CEO of the company. Hi, sir. Good morning, and thanks a lot for joining in. Well, let's focus on a couple of aspects of your business, and let's start off with the distillery business. You've gone ahead and you've increased the capacity from, I think, 417 KLPD to around 500 KLPD. So for this year, what is the volume we should be looking at in litre terms? And what does it mean in terms of revenues? The last time I recall a few months ago, you were telling us that that number is likely to move up. And also as a contribution of the total pie, distillery will contribute more. So please tell us that, sir.
Very good morning, Nigel, and thank you for having me on the show. So the distillery segment was doing very well up until Q3. We were growing at about 35% year on year. There was a policy change in Q3 wherein ethanol blending program, the diversion was pulled back, and subsequently our growth slowed, and we ended the year with about a 19% growth. The policy has still not moved back to the original policy framework, and given this, we will probably maintain the same or sort of slightly under growth trajectory going forward. In terms of capacities, we're a little bit above 500, sort of about 520, 530 KLPD right now. This will move up closer to 600 when another distillery is commissioned in Q2. So this is the kind of growth that we're expecting in the upcoming year.
Okay. All right, Muthiah, you want to give us it in litre terms? I think you were looking at doing something in excess of around 12 to 14 crore litres for the last year. What did you achieve in the past year, and what are you looking to achieve? And I think in revenue terms, it was around 800 crores. So we're saying you grow in high teens, you'll be in the vicinity of around 950 to 1,000 crores?
That's correct. And in terms of volume, we will be closer to 16.5 crore litres. Again, if there is a policy change, and we remain hopeful, this can move slightly above that.
And in margin terms, what will it be? It'll be in the same region that you have been delivering?
So we closed F24 with an EBITDA margin of about 12% on the distillery segment. I think we were on track to get to about 16-17% up until the policy change. We'll likely hold these margins going forward, and I think if the policy is reverted to, then there's perhaps a scope for margin improvement.
Okay, Muthiah, hi, good morning, and thanks for joining in. So that's on the distillery segment, but I want to talk a little more about the staples category in which you're trying to expand. And you have said that your aspiration is to capture more than 10% of the kitchen shelf in every household in South India. So tell us a little bit about that. What is the kind of investment that you're making here? When do you hope to get returns from it? And what is the potential that you see in this space?
So thanks, Sonia. So the staples category, we see it as a natural extension. We have branded sweeteners over the last 5 years, and we've had good success, but it's obviously a small component of the kitchen basket. We see staples as a natural extension, and also we see some of these categories, rice, dal, millets, all only sort of sub 20% branded. So there is a good headroom for growth, and there's a good headroom to leverage the equity of the brand. In terms of the strategy, we're starting with the straight. So, it is the base level products which are going in, helping us build distribution at the retail as well as the wholesale level. There's obviously a synergy between the sweetener distribution that we already have. And I think once this base distribution is in place and has expanded, we will look at value-added, higher gross margin categories within the staples segment on the lines of, roti mixes, dosa mixes, upma mixes, so on and so forth. So this is something you will see once distribution is well established.
Can you tell me, in terms of the investment, how much investment are you going to make now over the next 1 to 2 years, and when do you expect to see a break even?
So from an investment perspective, this is largely product development related, manpower related, and A&P spends. Overall sort of consumer business, the A&P spends last year was about 35 to 40 crores. This will grow by about 50 to 60% in F25. In terms of break even, I think it will take us some time until we build the critical mass from a staples perspective. If you look sort of slightly more medium term, we're aspiring to build a much larger consumer franchise than we already have. The sweetener franchise is about 550 crores. With staples coming in, that will aggressively grow. And I would say towards the end of the decade, we would like to build a substantially larger business with a late single-digit EBITDA percentage. That's what we are working towards.
So you've launched in Andhra Pradesh, Telangana and Karnataka as of now, right? What is... as well
as Tamil Nadu.
You plan to... In Tamil Nadu as well. Do you plan to expand geographically a lot more this year?
The focus will remain on the south.
Okay.
This is where our distribution, the focus will remain on the south for now.
And got that. Mr. Murugapan, hi, morning, Prashant here. Last time we spoke, you said the nutraceuticals business is under some strategic review. Could you give us a sense of, has that moved? Has that moved forward in terms of what you want to do with it?
So Prashant, I would still say under strategic review. We have wound down our operations in Chile. And some of the other segments, we are sort of subscale. So we still, continuing to look at alliances and look at opportunities for value creation. So it is still under review. We'll obviously make intimations once we have a clearer path around that.
So got that. So across, on an overall basis, I mean, sugar, cogeneration, ethanol, everything combined, refinery, could you give us a sense of the total sort of earnings growth that we will see, top line growth that we will see in F525, Mr. Murugapan, and also margins on an overall basis that we should expect?
So Prashant, we don't give guidance, but let me give you a sort of picture going into F25 in terms of how we're seeing the business. If you look at the sugar and distillery segment, from a sugar perspective, climatic conditions are improving. So this augurs well for the business going forward. Last year, especially in the southern region, was plagued by deficient rainfall. This impacted recoveries and yields. With climatic conditions improving, the outcomes from a farm perspective and an operations perspective should improve. We're also going to start the year with about 9 million tons of sugar stock, and this is encouraging and gives some leeway to perhaps for the policymakers to perhaps consider exports, as well as resume the diversion as per the original ethanol blending policy framework. So these, I would say, are the positives. The FRP also has been taken up by 8% this time, so that should have also encouraged cane planting. So I think we remain positive, but it's also pending how policy pans out. So this is from a sugar and distillery segment. I think we spoke about the growth path of the FMCG piece. Lastly, on the refinery as well, we've had a better operating year, and this is due to higher demand for whites, better cash premiums, and better spreads. We are hopeful that this momentum will hold, as there is still a bit of a supply crunch in the global market. It remains to be seen whether India permits exports, then the sort of global balance situation will have to be looked at.
All right, what was your export quota for last year and what is it this year?
There is no export quota, Nigel, for...
Oh.
Yeah.
Okay, and on your total sales mix, I think you had some percentage of your sugar sales which gets a higher realization, right? So could you run us through what is the percentage that gets a high realization and what is the difference?
So most of our sugar sales, Nigel, is focused on the retail segment and the institutional segment. So retail segment is around about 30%. That's what it's been for F23 and F24. We had some opportunistic trade sales in F24 when prices were good. F25, it's very likely that the retail segment will move north of 40%. In terms of realizations, we get a positive delta of about 2.5 rupees to 3 rupees compared to trade price because our focus is on institutional and on retail.
Okay, all right. One final question from my end then. What about the stake in Coromandel? A few years ago, you all sold some stake. I need to ask you this, before we wind up. Any further plans or no plans at all? Just to reconfirm.
Yeah, no, Nigel, I think we've discussed this in past calls as well. There's no such discussion. The focus is on, the operating business of EID Parry and ensuring that we sort of take our growth aspirations forward.
Okay, just one final word on debt. You have a long-term debt of around 300 crores, short-term debt at almost 770 crores. Any plans to bring it down in the near term?
So Sonia, the long-term debt is largely due to the capex cycle of distillery expansion, and I think the capex cycle is largely concluded or will conclude in another quarter. So I think it's important that the distillery business picks up steam to address that. And in terms of the short-term debt, this is because of high inventories. The sugar season has just concluded. It's really working capital related. It will get paid down during the course of business operations.
All right, we will leave it there. Thank you very much, Mr. Murugappan, for joining us and running us through and giving us a real sense of how various businesses are looking like as we get into the thick of F525 and beyond. That's EID Parry, 634 on the stock. Well, let's shift focus to PI Industries. The company's year-on-year growth has slowed down a bit. Pharma and agrochemicals were under pressure. But the company managed to improve operating profit margins on a year-on-year basis. Let's talk about what the future looks like. Mayank Singhal is Vice Chairman and Managing Director at the company. He's joining us now to take some questions. Mr. Singhal, good morning. Great to have you with us here on the program. Thank you for joining us. Prashant this side. So, sir, you've, on an overall FY25 basis, revised your revenue growth guidance to 15% from earlier 18 to 20%. Could you start here? Which segments is this slowdown in the rate of growth coming from, and just sort of put some qualitative aspects to this number?
Yeah, morning. Good morning. Once again, I think let me give you a quick background about the industry itself. As I'm sure all of you are aware that there have been very strong headwinds for the agrochemical industry globally, and there has been a negative growth all across the sector globally. Given that fact, I think PI has still performed well. We've still shown double-digit growth, very closer to line to what our plans were. But I do believe this hangover is going to continue in the global markets for the next year. Looking at that, we have given an estimated about a 15% growth. On the other hand, the company has primarily focused itself on becoming more efficient from a working capital standpoint of view, looking at product mix, and the domestic business has focused on value creation and looking at how we can bring about efficiencies in the process systems while these headwind challenges are. On the other hand, we have contracts which are in place, which are to be executed. A bunch of 7 to 8 new products are coming in both the businesses. And on the other front, we have also recently invested in building the platform areas of pharma, which will have its own colors playing up in the next 3 to 4 years.
Mr. Singhal, in terms of the broader, what you said, right, the backdrop, which has affected your growth guidance as well, when is a turn expected for agrochemicals? And what will signal that, in your opinion?
Yeah, so I would say that, looking at what's happened over the last year and a half is that there was overstock, as all of you are well aware. I think the destocking piece is now coming to, hopefully in a quarter or two, into control. On the other hand, the seasonal impacts have also been there. Given that if the first season globally goes well and the seasons play up well, I believe this is not more than a year plus of hangover.
Okay. So, is there a possibility, Mayank, hi, good morning, this is Sonia here. Just to complete this loop, you've scaled down your outlook to 15% in FY25. Is there a possibility that you may not even meet that 15% given how, concerned you are about the global situation?
Well, as I said, the global scenario is improving, number one. On the other hand, as you would know, that we have from what we know, that the best of our estimates, we have pretty well contracted revenues, and we're expecting to definitely see certain growth coming in the domestic business if seasons are favorable. So I think we could well hold on to that number for now.
Okay. And the CSM revenues over there, they de-grew almost 7% if you compare it on a quarter-on-quarter basis because of the decline in volumes. What's the outlook for FY25?
Well, as I said, we've given the same estimates of growth around 15% odd. I think, again, this business, as I mentioned earlier, is not a quarter-to-quarter. It depends on supplies and situations. It's in certain quarters and product mix which defines the volume growths.
All right. Hi, Mayank. Good morning and good to see you in. So 15% is the overall growth. Now, if you could break it up for us category-wise. CSM, Pharma and the domestic business. Pharma, last year you did around 320 crores odd. CSM was closer to around 6,000 crores. So if you could break it up for us, what could the difference be?
Well, I would not have the exact breakup here right now, but I can say that primary growth is going to come from the AgChem space. Pharma is still in the nascent stages. Obviously, we'll see a certain amount of growth there. As you know, that we've been investing to build a unique differentiated capability here. And that is obviously going to take its time. And in the PI way, we always take our time to put our right strategy before we see the numbers play out.
Okay, all right. What about margins? They're holding around this 26.5% odd. Given the industry headwinds, do you believe that you can sustain it around these levels?
Yes, we believe, and I think we've given that outlook. We should be able to sustain around that level. Yes.
Okay. What's the pipeline looking like now? You have 6 new products that were commercialized in FY24. What is the product pipeline in FY25 and 26? What can we look forward to?
I think we mentioned that we are looking about 3 to 4 or 5 products in the distribution locally. We're looking at 6 to 7 products in the manufacturing piece of the custom manufacturing export, where we are looking at commercializing some of those products for now.
You're also foraying into developing certain chemicals and advanced polymers for semiconductor applications, right? In the non-agri chem pipeline. What is the potential that you're looking at over there? Because that's a big space now.
Well, it's a big space, and it's highly technically challenging and a complex space in terms of what needs to be done, how it needs to be done. So we're happy to say that over the last decade, we've been actually wanting to play in this space. Today, we're going into commercialization of a certain amount of products which have certain unique technological and quality management capabilities. I definitely see this playing an important role in looking at the potential of this and India's outlook in the semiconductor and electronic space, this space to be a great potential. And having laid our partnerships and footprints in that, I think we should be in the forefront to look at the technological parts of this play.
Got it. Mr. Singhal, just to take you back to what you started by saying, you said a turn is perhaps not more than a year away, right? In terms of all these overstocking issues, etc., to be behind. So in a year like that, with all of this, you're guiding for a 15% growth. What would a turn and then kind of, a regular kind of market mean for prospects? Would you get to the 20-25% kind of range? Once that happens,
I think we need to balance our thought processes here. Today, PI's base has become big. We have to look at the industry numbers, and we have to be somewhere aligning, playing at the skills that we are today. So obviously, that is something, as you know, today, the weather and the climatical situation play an important role in this sector. And I think what one would wait and watch as to how things have turned up. But the PI strategy has always been to look at how we can actually isolate and manage this challenge. And so far, we've been tiding well, specifically given if you look at the present year, where it has been a very strong negative growth, and PI still delivered a pretty strong set of numbers here.
Okay, all right. Mayank, final couple of questions before we let you go. In the pharma business, you were indicating that maybe there could be some more inorganic growth. Are you all on the prowl in the pharma sector? And also, where do you see that number headed in the pharma business itself? Because you were looking for an asset for a while, you've got in there. You're doing around 300 crores or say in the next 3-4 years, where do you see this business headed?
Yeah, I hope to be at least easily, if not triple that number, double or triple that number in 3 to 4 years. And obviously, as you know, the CRDMO space is not about chasing the number, it's about chasing the right play and building the right capability. And just to take you a little back, I think when we built the PI CSM business, and some of you may have been aware, but it took me about 10 years before we could really play the game up. So 98 to 2008, we were investing, building unique capabilities before we really saw the numbers playing henceforth. So I think that's what we're targeting there. And I think not driving by numbers, but yes, numbers will come through. But it's more about building the capability in the platform to really be able to connect with the customer.
So if it has to triple the revenues from here, it's including some more inorganic growth?
That's not on the. I don't see that as we have enough right now to do. That's something we will see as and when if something interesting comes our way. As
so
you know,
1,000 crores from pharma in the next 4 years looks doable.
Yes.
Okay, that 1,000 crores from pharma in the next 4 years. You earlier guided for the fact that new products will be at least 30 to 35% of your total revenues in the next 3 years. Any change to that? And, what kind of contribution do you see from new products in the next couple of years?
Well, I don't have the contributions here, but yes, we guided about 30-35% from new products because constantly new products are coming and they're all getting scaled up.
Okay. All right.
For the big product, Mrs. Singhal, we, pyroxasulfane. As it becomes generic over a period of time, could you talk to us about what's happening there? That's your largest product.
Yeah, well, I mean, that has been discussed. I think as it gets generic, PI is a manufacturing part of the value chain, as you would understand. And typically in a generic, it is a marketing side, and the innovator is the guy who decides the strategy there. But we are a contract manufacturer, which is based on a certain understanding, and I see that ability to combinedly handle the generic. I don't see that as a challenge with the kind of understanding technological capability that we put together.
So in terms of price erosion for the product, could you give us sort of a glide path? What would it look like into the future? You'd have a good sense.
Well, that would not be for me to comment. As you know, I'm a contract manufacturer. It is more of the innovator who has that perception, right? So it holds there.
Okay. So just a final question before we end. This non-agro space, right, which is growing very well, whether it's electronics, semiconductors, performance chemicals, advanced polymers, where are you seeing the maximum potential for growth over the next, say, 3 to 5 years?
No, as we said, we're looking at these advanced polymers and we are looking at the electronic chemicals. And that's where we are focusing as an organization.
Okay.
And pyroxasulfone, you have already told us, is something quite optimistic. It continues to grow in double digits for the next 3-4 years. Do you have visibility on that front?
Well, I can't disclose that given the competitive intelligence and from our confidentiality understanding with our customers. I hope you appreciate that.
Okay, Mayank, appreciate you joining in and detailing those numbers. So 15% revenue growth, margins holding at around this 26% odd. The pharma business could possibly triple its revenues in the next 4 years or so. Well, for the time being, we'll slip in a short break. You come back, we'll have Manisha Gupta. She'll be telling us what's going on in the commodity market. Stay with us.
Welcome back to Bazaar Morning Call. Let's get a quick handle on what's happening in the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at the monsoons and the latest IMD reiteration that came in yesterday evening. You know, until the monsoons are on, you will see IMD coming out last week of every month to talk about the next month. And that's exactly what we had yesterday. So 106% of an LPA is what IMD is talked about and Skymet is talking about 102%. So while this is about normal monsoons, this is about above normal monsoon. But there are some detailings that IMD also did in the evening yesterday. So this is about what we've seen in sense of monsoon in last few years. So 106% is above normal, and this comes in after last year's below normal monsoon. So this year is something that the street is watching quite keenly with right now because there are various curbs in sense of exports. Import duties are free for various essential commodities, and there are other restrictions as well on many of these agriculture essential commodities. And if it's a good monsoon, then we perhaps are looking at good numbers in sense of crops as well. And so when you look at the detailed forecasting, and this is what the IMD did yesterday, they are talking about above normal monsoons in central and southern peninsula. And that's a good news really because this is majorly your food bowl as well. When you talk about below normal monsoons, there are concerns still continuing in case of Northeast India, while Northwest would be looking at normal monsoon. Is the reason when you look at the overall monsoon itself for the month of June as well, the IMD does say that they're looking at a bigger probability of anywhere between 90% on the lower side to 108% on the higher side. Now, these are the probability metrics that the IMD has come out with. 31% probability of a normal monsoon, 32% for above and 29% for excess. And this is what comprises of 90% of your probability is there. So there is very little chance that you're looking at a below normal monsoon. And even if that does happen, then it's only in case of Northeast and adjoining Central India there. The rest of the part of India is looking at good monsoon this time around. This is what we are looking at in sense of June. So the overall rain is anticipated at 92 to 108%. Northeast will be below 94%. Is the reason that metric really comes on the lower side there. But apart from that, Northwest will look at 92 to 108%. And that's exactly the scenario that the IMD is anticipating for western part of India, southern peninsula and most part of north as well. Now, the June is, while you are looking at an onset of monsoon, but this is not without heat waves that are expected to continue for this month as well. The IMD says that it is about the strong, dry, warm winds, lack of rainfall in the month of May. Also, the fact that you're looking at a reverse or an anticyclonic circulation over southwest Rajasthan and Gujarat is the reason that you will look at these heat waves continue for the month of June as well. So even as we are talking about monsoon, there are heat wave advisories for the next 3 days until the first week of June as well in various parts of Delhi, Punjab, Rajasthan, Haryana and in some parts of Gujarat as well. That might just continue, but the IMD also says that for the next 5 days, you could be looking at onset of monsoon in Kerala. We're also looking at very important kharif crops as we go ahead. So most important really is rice, soybean, cotton, maize and pulses. And then, of course, you have some commercial crops as well coming in. And we are looking at restrictions right now in most of these crops. So if you are good monsoons and we see bumper crops of these coming in, then there is an expectation that as soon as we see the new government coming in, there would be a lot of help. It would help farmers produce bumper crops. It would also lead to restrictions being eased going forward.
Okay, thanks a lot for that. Well, that's on the commodity side, but let's get back to the markets now. Ekta is with us to talk about Natco Pharma and why you should be watching that one. Ekta, over to you.
Well, good numbers which have come in for Natco. It was the highest ever revenue and profit for FY24. There was a one-time charge of 90 crores in the domestic business, but the street seems to have shrugged that off. The numbers have been higher mainly due to the contribution of Revlimid generic. That is contributed on an FY24 basis as well as on a Q4 basis. However, the numbers are below Novama's estimates, which was estimating a little more in terms of growth. So revenue for Q4 has come in at around 1,068 crores. Street was anticipating 1,100 odd crores. EBITDA 497 crores versus estimates of 500 crores plus. Margins 46.6%, which have improved both year on year and Q on Q. And a profit of 386 crores. Street was anticipating over 400 odd crores. So despite it missing estimates, remember it is a very strong growth that you've seen on a year-on-year basis for Natco. The street seems to be extremely positive on the prospects. There is a conference call at 11 a.m. We'll get more details then.
All right, Ekta, thanks a lot for that. Well, let's go across to Vivek now. He has Borosil Renewables on his radar. Vivek, over to you.
Well, like we said, FY24 has been quite underwhelming as far as Borosil Renewables prospects were concerned. Revenues, as far as Q4 was concerned, was down 8% on a year-on-year basis, not due to lack of demand as far as India was concerned. In fact, demand outstrips supply, but there has been significant dumping as far as Chinese module makers are concerned, and that is something that has gone ahead and given quite a bit of a knock as far as pricing is concerned. Now, talking about the operational performance and operational loss this time around of a little over 25 crore, and on the bottom line, there has been a loss this time around of over 50 crore versus a profitability of a little over 10 crore last year around. Now, what is the company saying? Number one, overseas subsidiaries this time faced demand headwinds, especially in Europe. Along with that, EBITDA was weaker on the back of two things. Number one, a result due to lower selling prices in India on the back of dumping that we just alluded to, and also lower production in overseas subsidiaries due to much lower demand as far as the European markets was concerned. Now, talking about the key product that the company is, the solar grade silicon, the prices of that dropped by 80% on a year-on-year basis to 10.3 cents per watt, and this is as recently as May 15, 2024. So overall, there has been demand weakness abroad and there has been price weakness in India. Looking forward, number one, the company is saying that they're going to do a rights issue of almost close to 750 crore. This will be to pay long-term debt. And more importantly, to watch would be the imposition of ALMM that could improve the prospects of Indian domestic module makers.
Okay, thanks a lot, Vivek, for that. That's Borosil Renewables. NMDC is also in focus. Nigel is here to tell us why. Nigel, over to you.
Well, that's right. NMDC's numbers are quite disappointing, but this is some positive news that's coming in there for NMDC, because we understand from sources that effective today, they've gone ahead and they've increased prices. On lumps, they've increased it by around 250 rupees per ton. And on fines, it's around 350 rupees. So there's a rather large price increase that's come about. And that's not all. This is the second price increase we're seeing. Remember, last month, towards the end of April, we did see a price increase to the tune of around 400 rupees on lumps and closer on 200 rupees on fines. Getting into a monsoon, well, this will be good news for them if they can hold on to this. So price increase comes about for NMDC. Some part of the street was factoring in that there could be a price increase, but all this will bode well for the Q1 numbers. Though Q4 was quite disappointing in terms of an operational performance, this price increase could flow through to their operational performance. So that's why, in fact, the street is reading it positively. Back to you.
Okay, thanks a lot, Nigel, for that. So that's NMDC. Let's slip into a quick break. On the other side, Pranjal Bhandari, the Chief India Economist at HSBC, is joining us here in the studio to discuss the expectations from the upcoming RBI policy, post-election reforms, and lots more. Stay tuned. Welcome back. Let's talk about the economy now, because we have several things lined up. There's, of course, the election results. Then there's a full-blown budget that we'll have in July. In the middle, there is an RBI policy as well. Pranjal Bhandari, the Chief India Economist at HSBC, joins in now. Pranjal, she's here with me in the studio, by the way. She's based in Singapore, but she's in India now. So, Pranjal, thank you so much for, first of all, coming here to the studio at a very important time, right, for the economy. We're heading into a big event. It could be a binary event for the market and the economy, but how are you positioned in general, and what is your expectation from the budget in July?
Okay, great. So look, good to be here in the studio. So I think in terms of growth, I think India is in a pretty resilient place. Our growth is pretty robust. On Friday, we are going to get the GDP data for the March quarter, and my sense is generally activity in this quarter has actually been better than in the previous quarter. All the PMIs are higher. The construction sector has taken off. It's not just public capex, but it's also real estate capex. Construction creates a lot of jobs in rural India. Rural incomes have started to do a little better than before. And then we've got the RBI dividend, which makes the fiscal consolidation a little less painful on growth. So all of this is coming together, and I think we're in a good place in terms of growth. So, I'm excited for the big events that are coming up. I think India is entering on a place of strength.
Okay, so you're saying growth is robust, real estate capex has taken off, and things are looking good, right? Now, what this market wants is continuity of policy and a smooth transition as well of the new government. The expectation is that the current government will come back to power, and then policy continuity is something that one can expect. But what are you looking at? Apart from growth, what are the 2 or 3 things that the government can do now to strengthen the economy further?
Yeah, so I think the reforms that the government articulates in its first 100 days or so is going to be extremely important for the medium-term growth of the economy. And here I sort of break it down a bit too simplistically into easy reforms and hard reforms. Easy reforms, although they're not that easy, are things that the government has already been doing well and just doing more of that. For example, attracting investment in futuristic sectors. We had Apple, we're getting semiconductors, perhaps EVs. So a bunch of, that, continuing with public capex, ensuring that macro stability is intact, getting some disinvestments done. I think if all of this continues, then we're like a 6.5% GDP growth economy in the medium term. But if we want to aim for more, 7.5% to 8%, which, by the way, we need for the kind of jobs we need to create in the next decade, then I think the government needs to take on much harder reforms. Land, labor, ease of doing business, farm laws. And my sense is we'll know in the next 100 days, what this government wants to really pursue. And the growth dividend would be either a 6.5% growth economy or a 7.5% to 8% growth economy.
So you said easy reforms like continuation of public capex is something that is perhaps a low-hanging fruit. But some of these harder reforms, land, labor, ease of doing business, is that something that you would expect could be taken up in the first 100 days itself? Or is that a tall ask, given the way, the macroeconomic and the global situation is panning out?
Look, these are tough reforms, like farm. We've already had an experience with that in the past. For this, a lot of consensus has to be built. So I don't think, really getting these bills passed will happen very quickly. But we'll get to know if the government is really pursuing it, if they are starting the conversation, they're reaching out to stakeholders. I think that is something that will be clear in the next 100 days, if the government is actually interested in these reforms in a 2 to 3 year horizon.
Okay, that's about the government, right? I want to also ask you about the RBI's intention. What do you think could happen in the June policy? The expectation is that the rate cuts will be very slow, they will be very shallow. So realistically, what are you expecting?
A very interesting thing has happened in inflation. For the first time in the history of tracking the data for me, I'm seeing core inflation fall at a time growth is extremely robust. And I looked into it very carefully. How come core inflation has halved over the last year? And my sense is 3 things have played a very important role. Number one, Chinese disinflation. China export prices are falling. India is importing many more consumer goods from China. And through that channel is actually importing some of this disinflation. I think this is a very important part. The second part is RBI being hawkish. Now look at this RBI. They were able to bring down inflation from 6.5 to 5, but instead of patting themselves in the back, they keep saying, oh, the job is not yet over, we need to get to 4. They keep sounding hawkish. That in itself is important for driving down inflation. And third is the commodity price fall. The fact that compared to 2022, in 2023, we saw oil prices, metal prices, and all of these prices fall, and manufacturers were able to cut prices. So I think all of this has brought down core inflation. Out of these, I think Chinese disinflation, RBI remaining hawkish will continue. But what I'm beginning to worry about, and I think a lot of people are not talking about it, is commodity prices. Year to date, commodity prices across commodities has risen by 11%. I think that's pretty high. And my sense is, given global demand has surprised on the upside, this is something that could continue and that would come in the way of the RBI really easing. Does the RBI really have to ease? Not really. Growth is robust. A little bit of easing can happen via liquidity. Remember, in June, July, once the government starts spending again, once we get all of these index-related bond flows coming in, liquidity will be looser. Some effective rate cut will happen from that route. So my sense is, putting all of this together, if we cut, we're going to cut minimally, not too much. We have the Fed forecast of Fed cuts of about, 1 this year, 3 next year, overall 4 rate cuts over a 1 year horizon. I think for every 4 rate cuts the Fed gives, I think RBI can cut by about 1 or maximum 2.
So in the June policy, at least there's no expectation of a rate cut.
No.
In September, is that your base case?
My sense is no. I think we'll wait for the end of the year. Our Fed forecast is for the first Fed rate cut in September, and there's a lot of uncertainty even about that. So we'll see where that goes, what is the impact on the dollar, and I think the RBI will first start considering it in the fag end of 2024.
Okay. I wanted to come back to the economy just to understand what else can we expect, from post the election and from the budget, right? Where are we at in terms of a pickup in the capex cycle? You spoke about real estate capex picking up. Corporate capex, I think, are seeing some green shoots. How is the rural economy looking? What are some insights that you can share with us?
Yeah, so 2 points here. We got this RBI dividend, this big bounty of 2.1 trillion rupees. It's about 1.3 trillion higher than the government had estimated and budgeted. My sense is that they could split it between saving and spending. So about half of it they could use to lower the fiscal deficit and to lower the government borrowing, so by about 600 billion. But the other half it could use for welfare spending, and that's something to look forward to in the budget. When we had the interim budget in February, capex was well provisioned for, 17% year-on-year growth. That's a lot. You can't do more than that. You don't have implementation capacity on the ground. But what was under provisioned was welfare schemes. It was actually cut by 0.6% of GDP. So my sense is that we will provision for that a little more, and we could see a little more welfare schemes out there, which, by the way, will be great for consumption, for mass consumption, which indirectly will be good for capex. Now, coming to capex, public capex is great. We've been seeing that. But it's only 25% of overall capex. The big question is, when will the remainder, 75% private come? So there are 2 parts to it, domestic and foreign. Domestic is waiting for capacity utilization to rise, for mass consumption to rise, and if the government can have some welfare spending in its budget in July, then perhaps that will help, increase the prospect and improve the prospect of domestic capex. Foreign capex is a little more problematic. We all talk about nearshoring, reshoring, but if you look at the hard data, not too much has happened. too much of manufacturing chains haven't yet moved. So we'll have to work harder. We'll have to do all of those reforms, ease of doing business, land, labor, if we want to get a lot more of the foreign capex to come in. But overall, if a little bit more focus on welfare spending, I think mass consumption will be better and we could start seeing some domestic capex pick up. Okay, so the focus is on welfare spending and hopefully that will help pick up mass consumption. Pranjal, thank you so much for joining us here, coming to the studio, and we have big events upon us, so we'll try and touch base with you once those events are out of the way. Well, with that, it is curtains down on this edition of Bazaar. Thanks a lot for watching. The market is fine, actually, holding on around the 23,000 mark on the Nifty. The mid-caps have slipped slightly into the red, so don't lose sight of that. The mid-cap index is now down about 80 odd points, so it's getting a bit volatile for the market. Chartbusters will take all the action ahead.